to the future, thinking that building a position in Dollar General at current levels now makes sense. So they like what they see as far as a change at the helm of this overall company. And like you said, an 8% pop here off the open, and they needed it. Shares were pretty much at 52-week lows as of yesterday's session.
Yeah, I mean, Owens only had the job for what, a year, and the stock is down about 54% over the past year. But you have to wonder if he's looking at the stock surge and feeling pretty badly about it. That being said, Bezos must, I don't know, I always think that they must feel pretty good if they see the stock pop on their appointment. So investors clearly happy about this one. Still more holds than buys in terms of the analyst breakdown, despite that, the upgrade that you talked about. So we'll see if some other analysts follow suit. Meanwhile, one of the big down movers this morning is Fortinet. Shares down, actually not as bad as it initially looked. Shares down more than 1% after a downgrade. Fill us in on that story.
Right, shaking off this downgrade pretty well, I'd say, with the overall market strength. Barclays, though, did downgrade shares to equal weight from overweight with a reduced price target of $63 a share, down from $71. And the analyst cites the firm's incrementally negative channel checks, lower prioritization of firewall refresh in its chief investment office survey, and risks to its multiple at now 23 times its fiscal 2024 free cash flow behind this downgrade. However, they do think there's a more balanced risk and reward at these current levels, and that Fortinet's platform approach gives the stock still some terminal value. So it wasn't necessarily a super outright negative note from Barclays today. The stock up until this morning was up 19% this year. It's down about 28.5% from its highs, but all things considered, still holding on to a near 20% gain this year. And the street does like this name. Of the 37 analysts I was seeing, 27 do have buy or buy equal ratings. There are 10 holds, but no sells, no even underperform. So that puts it at around a 73% buy rated ratio. And the average price target of around $74 a share does imply, 29% upside from where we're currently trading. So even though this price target today, 63, does put it below the average, Street still does feel pretty optimistically on a name that's been able to hang on despite, obviously, as you can see there from the yearly chart, that nosedive it took after earnings about a quarter back.
All right, good breakdown and insights there. Jenny Horn, thanks so much.
Thanks, Caroline.
For more on the headlines this morning, we welcome in Jeff Pierce, Senior Manager, Derivatives Trading at Charles Schwab. Jeff, thanks so much for joining us. Let's get back to bank earnings because we were taking a look. Citi, Wells Fargo, JP Morgan, all higher today, up by at least 3%. PNC, different story. Shares down more than 1% right now after that report. What stood out there? What's weighing on shares?
Yeah, unfortunately for investors, there weren't a lot of numbers to be positive about in this report. Earnings per share did beat at $3.60 versus the $3.10 expected, but that was down 5% year over year. They missed on revenue, coming in at $5.23 billion versus the $5.32 billion that was expected. That's down 6% year over year. On the average deposits, those fell 4%. Net interest income fell 2%. From a year ago to $3.42 billion. That was, just slightly above what analysts were expecting at about $3.41 billion. Non-net interest income fell 12% from last year, and the bank provisioned about $129 million for credit losses. Now that's down from the $241 million we saw from a year ago, but still a fairly high number.
So, Jeff, what do you think? Is this a case of big banks versus regionals, or is this PNC specific?
Well, certainly PNC has some things going on that are specific to the company. We know that reports are coming out that they're planning to reduce their staff. There's no real detail around that yet in terms of the number or where we're going to see those reductions happen. But certainly, this is a bank that was hit hard during the banking issues, and they're continuing to try to come back from that. This is certainly a difference between some of the larger banks out there and some of the more local, smaller banks, and we're seeing them try to struggle to get back with their previous numbers in terms of where their stock was. And we know PNC has been making some moves as well. They acquired about $16.6 billion of capital commitment facilities from the Signature Bridge Bank agreement. They have acquired about $9 billion of funded loans from that as well. And they said they expect about a 10% per share boost in Q4 from the deal. So the numbers, could see a boost as we go into Q4. I think investors are still trying to figure out whether or not these banks are going to start to see deposits come back again.
Okay. Meanwhile, not just banks reporting earnings today. United Health also released its quarterly results. Shares up more than 3% on that news. What stood out there?
Yeah, definitely a different story here. We've got earnings per share that beat $6.56 versus $6.32 that was expected, up 13% year over year. Revenue beat as well, $92.36 billion versus the $91.37 that was expected, up 14% year over year. Optum revenues were up over 21%. Overall premiums were up over 12%, coming in at $72.3 billion. Medical cost ratio, that was about 70 basis points higher to 82.3. That's compared to 81.6 last year, but that is a relatively good number. That's been something that investors have really been focusing on. There have been a lot of concerns about that medical cost ratio. On top of that, the company also said that they serve about 700,000 more customers in 2023, and they raised their outlook for 2023. They expect earnings per share between $24.85 and $25. That's up from the previous expectations of $24.70 to $25.
And United Health now positive year to date, but only up about 2%. So technically outperforming the broader sector, which is still negative on the year. But why so out of favor? These numbers seem pretty good.
Yeah, these numbers have been good. There have been some concerns. If you look at mid-June, the company fell after they said, patients are really starting to access services that they put off during the pandemic. That includes operations as well. They were concerned about the medical care cost ratio. They said for the second quarter, it would be in the upper bound or moderately above the upper bound of its full year outlook. And when we saw a second quarter number come out for medical loss ratio, it came in at about 83.2, higher than what we had seen last year, but not as high as investors had feared. So I think, investors are starting to let go of some of these concerns around the costs that are still piling in post-pandemic. But we're seeing the stock, tick up slightly because I think, investors are seeing that this medical cost ratio has not been a problem in the way that they expected it would be.
Okay. You're also tracking Applied Materials and Lam Research today after Needham upgraded both. It doesn't seem to be having an impact on either share, basically at the unchanged line. But what did the analyst have to say?
Yeah, for Lam Research, Needham moved them to a buy from hold with an $800 price target. For Applied Materials, moved them to a buy from hold with a $180 price target. The analyst says they see the wafer fab equipment sales at $90 billion, $90 billion, and $100 billion for 2023, 2024, and 2025, noting that that's above the consensus call for 2023 WFE accounts. They see exceptional strength, and part of that's coming from ASML and Chinese semicap this year. The firm thinks that its 2024 and 2025 WFE estimates are also above what the street estimates are for the year. If you look at these stocks, some volatility in the semiconductor sector recently, especially after we saw some of the numbers out of Taiwan Semiconductor, where they said sales were down 13% year over year. We also saw that they were trying to delay some of the equipment deliveries because of a slowdown in demand. But if we look at these names, you think about AI and what that means in terms of computing power that's needed. These are names that could benefit from that. And we know governments kind of across the world are really trying to subsidize these chip manufacturers to continue to meet that demand.
And this Needham analyst now joining the majority. I was taking a look at the breakdown. Both Applied and Lam Research have more buy ratings than hold ratings, and both are up 50% or more year to date. So is this a little bit of catch up, maybe a little late to the game?
Yeah, it looks like a bit of catch up, trying to get where the company is and where the other analysts are. But these come after reports. It's been tough to read these names, right? I mean, you look at the charts of 93% for Lam Research over the last 12 months, Applied Material up 83% over the last 12 months. If you look at some of the reports, revenue was down 31% year over year in the Q4 report for Lam Research. They saw, their outlook was decent, but still seeing some numbers that are struggling year over year. Similar scenario for Applied Materials. So it has been a tougher read. We know that AI is obviously the big, sticking point for these companies, what we're going to see going forward in the future. But certainly investors are excited about AI. The question is, when are we going to really start to see that develop for some of these names?
Okay. And finally, you're also looking at Ford. Shares under pressure this morning, but only down about 0.3%. Stock only down basically that for the week, despite the strike continuing for week 4. What's the latest with the UAW strike? Any progress there?
No, not really. At least not on the side of Ford here. In fact, Ford came out, the president of the traditional combustion engine vehicles, Kumar Galtra, says that the maker is at its limit and that any more will stretch the company's ability to invest in the business. They said the Ford Kentucky truck plant generates about 16% of Ford's revenue, and a prolonged idling would likely cause stoppages and layoffs at up to 13 Ford plants that make engines. These comments come after we saw the union launch a strike at their SUV and pickup truck plant in Kentucky. Apparently, Ford was surprised by the escalation of it, and the strike, which went into effect Wednesday, is certainly a big one. We've seen some strikes start to have effects on these companies. We know parts have been a struggle in terms of getting new parts to a lot of the auto dealers out there. The kind of week by week, deployment of new strikes has not had a huge effect on the company so far, but we're starting to see it. And it sounds like Ford is starting to say that these are going to have real impacts going forward.
Are you surprised that we haven't seen the stocks take more of a hit? GM is definitely the biggest loser this week. Obviously, the strike in Canada likely not helping shares there, which Ford was able to avert. But when you take a look, Ford is still up year to date, only about 3%, but still. GM is down about 10.5%. Stellantis up 41% year to date, up 3% almost this week. Are you surprised that these stocks aren't getting more beaten down? Because it doesn't seem like there's really an end in sight for the strike.
Yeah, absolutely I am. I mean, there's a lot of different things going on here. This gradual strike, as I said, hasn't had an extreme effect on either party. The automakers haven't really felt it on the bottom line yet. The UAW has not stretched out their strike fund. But if you look, last week, GM said that they estimated the strike had cost $200 million in lost revenue in the third quarter. Now we know dealer inventories have been good. Dealer inventories were at 2.06 million vehicles. That was up from what we saw, the prior month, and one of the highest levels we've seen since March. We know the UAW strike fund is about $800 million, so they've got some time to work with on this. But yeah, I'm certainly surprised, especially as it's escalated, right? We've seen 6, 7, maybe even more offers come out of these big three car makers, and so far none of them have really reached the agreement that the UAW wants.
All right, well, Ford and GM under pressure today. Stellantis up another 1%. Have to leave it there. Jeff Pierce, thanks so much for breaking down those movers for us. Coming up, we'll go inside out on bank earnings. What did this morning's reports mean for the entire group? That's next on Morning Trade Live.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free
Good morning. It is October 13th. We're streaming stock market, trading stocks, options, and futures today. Hope you guys have had a good morning, good rest of your evening yesterday. I'll be watching SPY, GME, AMC, whatever's popping. We work day trading. These 0 days today. I guess everything's 0 day today. That's weekly. Thanks for being here. Appreciate your support. Sub up, like up, comment down. Happy Money sticks around. You can follow us on Twitter at HappyMoneyYT. And we also have a Discord server. Link for those in the description. Put a link for Discord and chat as well. Market opened up about 20 minutes ago. Got 3 likes on the board. Well done. Thank you to the 3 of you. Appreciate your support. It's a bit choppy. Did have a gap up. It's up 0.5%. AMC's down 3. Got GME down 1%. The SQH is on the top of my watch list, up 24%. Groupon up 12. Glad I closed those puts, jeez. Progressive, is this Progressive, I think? Yeah. From earnings, yeah, Progressive had earnings are up 7.6%. JP Morgan's up 4.8, wow. Base is up 4.5. It's kind of choppy this morning. I did grab a put and or a few puts and I closed them. Just feeling it out so far. Looking out for a little double top here. And maybe a channel break. Otherwise, I'm just sitting back. We could be climbing up to this resistance high from 2 days ago. Complete kind of that right shoulder. Or even a triple top actually, because the head was just being the after hours. So that's 437.22. Oh. SEC to finalize rules increasing transparency of short selling market. Is that from like 2.5 years ago? They're finalizing it now? Congratulations. Got some puts there. I like the double top. Close to BBOP, unfortunately, but yeah. There's a little BBOP test. Whoa. Whoa, 10 o'clock, there's data or something. Dang, I was not prepared for that. Consumer sentiment preliminary. Okay. Well, glad I went the right direction. Alright, low of the day, I'm gonna close one here. Wow. Put a stop on the rest. Close another one. Since that was just a reaction from the data, I might just flip around if possible. Close one more. See if I can get a stop on these before it goes negative. Yeah, see that bounce. Mm-hmm. Yeah, it's already negative. Beautiful. And right back up. That's where I have to have a faster brokerage. That was crazy. Proper scalp trade. Okay, now I'll put my stop in there. One-year inflation expectation went up to 3.8 from 3.2. What were the expectations? Supposedly less than that. That was a pretty big reaction for that data, I think. Consumer inflation expectations. I feel like we usually get that big of a move from it. Got fortunate. I didn't realize the data was coming, or I would have probably waited. Maybe not though. I mean, it broke the channel, what I was looking for. Interesting how that happens, how it just works out like that. Same with yesterday when that bond auction came out. It was literally right when SPY was at the spot where it would either bounce and stay in the channel, or if it broke there, it was going to flush. And just happened to line up perfectly with the timing. AMC's down 4.25. Bouncing on the low there again. Oh, there you go. A little fleshy. Maybe gonna take a little more profit there. I don't have many contracts. These morning trades I trade with a lot fewer. Just have less certainty and it's just more choppy and yeah. Oh, AMC dumping there, down 6.5. Closing out of one more of these puts. New low there on SPY. That's in the bottom of the channel. Dish is up 1%. New low? Yeah, I think a new low on SPY. I'll close another one there. And last one for the homies. Let this one get stopped out. Maybe, we'll see. I'll move the stop down so we get some profit from it. Just get a little room to breathe. Get a reload on them with a sort of pattern. It looks like might be bullish. GNS down 7.4, AMC down 7.3 now. Top's down 5. Might be a nice pickup. RAD's down 3.6. Yeah, I'm picking up a couple calls there. I might want to fill this gap first. GME down 1.3. Coinbase down 2. Confluent down 2. Open door. Wow, look at Rover. Red Rover, Red Rover. Things like quite a move. SPY just chopping around down here. We'll see if he wants to fill this gap before it goes back up. Why not, though? I want to get rid of yesterday's. This morning. Okay, added to my calls. That was above that resistance. Close. Oh, GME's coming down though. Is that the front runner for SPY? He's down 2 now. Yeah, it stopped out of my put. I moved it up so it has more of a profit. It wasn't break even. I'll close some of these calls at the VWAP in this channel, top of this channel. Still down on him, huh? VinFast is up 4%. We'll bounce there. Oh, SPY coming back down. Looky, looky, looky. Interesting. Very choppy. take a break after this trade. Bars getting back in, it's so choppy. If it breaks this channel, I'll be more confident. Falls. At least a high a day. But that's not even that big of a move.
Significant it is. So RSI also not giving any help to the
Talking
bulls
about
here,
Netflix
crossing
here.
into the oversold area, typically regardless.
Well, we're
of
about an
sign
hour
of
in
weakness,
market
especially
today,
when
guys.
it's
Thank you for your
concurrent
support.
with a move
The 7 of you that
support. So
took
looking to
time out of your
potential
day to give a
support
thumbs
to
up on the
further to
stream.
downside here,
Appreciate
the
it.
340 level, this green dashed line, we had a small gap there. That could be a point to watch. Gaps often are filled in charts. It doesn't happen every time, certainly not a guarantee, but that is something that happens so frequently. It's something, you know, a common trading adage to look for those gaps for potential support. To the upside, we got to crack above this area once again near 369 to 371 or so.
Not
if we
one
do
bit.
look for a potential retest of our long-term trend line up there near about the 400 level or so, that would also roughly match up with our 63-day EMA in orange.
All right, a lopsided triangle. Let's move on to Tesla. Renita, shares off about 1.4% today. A loser on the week despite the Nasdaq's overall strength. They report on Wednesday afternoon as well. What are the analysts saying?
Well, for some perspective, competition in the EV space has been red hot lately. So in the third
Didn't quite make it to the top of the channel, didn't make the VWAP.
300,000.
Might still make it up there, but I don't like this chop at all.
That was pretty huge for that third quarter. That was a big deal. However,
I'll add on
Tesla's
the
market
channel break.
share is fading. It used to occupy about 62% of the market share in the first quarter. Now it dominates half of the market, and it missed market estimates for deliveries in its third quarter. That was thanks to upgrades at its factories that halted production for a time. And that's why the Cybertruck is so important, Caroline. It's been highly anticipated for years, and it's expected to be delivered to customers in the current quarter. By the way, Tesla also released that it released a couple of alcoholic drinks that are tied to the Cybertruck. I think it's the Cyber Beer and another one that they're hoping to add to their business lineup. But when earnings come out on October 18th, analysts expect them to fall year over year to 73 cents. Revenues also expected to fall year over year to $24.38 billion. We'll also be looking, of course, to see if there are any price changes, as always, and if demand and inventory levels change as well.
All right, I was just trying to find a picture of the Tesla Cyber Beer, wondering if the can looks anything like the truck.
Expound does want to fill this gap.
Oh yeah, it is.
It is, yep.
2 bottles of beer for $150. Rick, is that your weekend plan here?
What a deal.
Take a
You know, if it looks anything like the Cybertruck, it's probably the ugliest beer I've ever seen then. But, you know, once again,
AMC's down
triangle
10.
shape here. The same type of pattern that we saw in our previous chart exhibited here once again here with a longer term trend line across the lows, a shorter term trend line starting with the highs. The key difference here, this one is still within the boundaries of both trend lines.
Like how tight the
we
range
have
is.
some competing price
Could have taken
action
puts
here. We
here
got some tension
when I close
here.
my calls,
We're
but
looking for a breakout beyond either of these
downside,
trend
maybe
lines here.
gap
And
fill.
you can see that our moving averages are kind of reflecting the chop that we've seen.
Wasn't
the back
prepared
and
for
forth price movement bouncing up and down between these two boundaries. Moving averages are flattening out, not really seeing strong directional bias in either direction. We are slipping below the yellow 21-day EMA as we speak, though, so that's an interesting development.
10.5% on
if we were to
AMC.
close below that level, it would be more of a bearish sign here. Right before this segment, I would have said we were a little bit more biased to the upside. But, you know, the volatility is kind of shrinking when you get this type of triangular shape here, and that's reflected in our RSI as well. Look at, we have a similar situation happening two trend lines, one going across the highs, one going across the lows, going toward each other with RSI smack dab in the middle near the 50 line. Once again, not really giving us a clear read one way or the other. So low volatility is often the precursor to high volatility. So there could be a very energetic breakout if we were to get beyond one of these two boundaries here. I think probably the path is a little easier to the upside. There's less potential resistance. If we were to break above our channel here, our trend line here, we have the start of a gap right here and then the subsequent highs right around the 279 mark. So that would be one key area to watch if we do start to move to the upside. And just another note, we're right in the middle of a big volume node too. So this could be a congestion area. This is a key
could take some profits here
as well, near the 260 mark. If we break to the downside, we've got our
switch
trend
to sign
line,
off to stop
then
out my
we've got
put
our
too.
purple 252-day EMA
Put
coming
for the
in near
homies.
231, and a big
What's up,
line in
Maui?
the
Aloha.
sand based on these old highs and these lows would be around 213 as well. So that could be one more area to watch if things really start to unwind.
All right. So, Rick, I don't think you're probably going to like the bottle, and I don't think you probably like the price. But just in case, the beer inside is a German pale lager, typical of Munich, that's brewed in California. It doesn't seem, according to Electric, doesn't have a great rating on Untapped. A fairly average rating. But, hey, 150 bucks. It's a steal. All right, Renita, Rick, thanks so much. Coming up, Jenny Horn has the latest on Boeing's sell-off today. Then it's market meetup time. That's next on Morning Trade Live.
Does seem like we're starting to taper down here though. Good first sign. Kind of want to see that gap fill, and then maybe I'll grab some calls. Bottom of this channel. Does love to fill gaps. Holds up on this channel. coming for its gap fill. High IV on save. Where that is. Maybe earnings is coming up? Probably. Yeah, I think so.
It's relatively positive, and if you go back to even a few weeks ago after the Fed meeting where the markets got to the
fighting for that
downside,
gap
we've
fill.
recovered nearly that entire loss. So I think that's a good sign. I think today's action is relatively balanced. We had some nice movement in some of the technology names earlier in this week. I think there's some
If it doesn't
pause
retest
in
this
those
low, this
names and
channel though,
rotation into other
yeah, that
areas
gap's
where
filled.
there's strength today. Obviously, financials are performing quite well. We're seeing energy move to the upside, but there's still some weakness, and some of the food stocks are down again today. Looks like some of the airlines and travel stocks are also down. So I think this is normal rotation, considering some of the earnings announcement we saw out of the major financials.
And Scott, George makes a good point. Despite sticky inflation, geopolitical turmoil, higher for longer, this is a market that ultimately is higher on the week outside of the Russell. So what does that tell you about the market's resilience and where it goes from here?
What this is telling me is that the bulls are trying to establish some solid footing. And I think that, if you look back at the week, the data that we got through the week as far as our inflation and various things, it didn't come in all that solid. Now, it wasn't damaging, but it didn't come in all that solid. We do know that our labor, our employment's still tight, which is helping us, but we saw the consumer sentiment drop a little bit. We've seen import prices a little bit weaker than forecasted. 30-year mortgage is still on the rise. CPI shows inflation for September was hotter than we thought it was going to be. And so, we see all these things that, one might look at that
there's
and
a flush.
say, what's going on here? We may be in some
Paper
trouble.
not
However,
happening.
when we start seeing earnings come out like we have from the bank, and we have JP Morgan Chase reporting quite well this morning, even Wells Fargo and so on, if we're really seeing that the banking struggle is over, we're starting to see some capitulation in some of these attitudes and numbers and the sentiment, etc. So I think that that's just the bottom line, Caroline. I think that, bulls are just wanting to drive the market further higher. And so far, they've been able to hold their ground pretty well.
So, George, do you think bulls will be able to continue to establish this solid footing that Scott speaks of?
Well, I actually do. I think, in the near term, you could see some weakness just because we've had a nice run up over the past, couple weeks or so after our initial decline post-Fed meeting in September. I think going into the end of the year, I think the market's going to look strong. Interest rates, to me, are relatively stable right now. We did see the run up in long-term rates. That creates some concerns. But we're seeing, again, those long-term rates come down about 20 basis points in the last week. That's a good sign.
Wow, SPY.
I think in actuality, if the Fed maintains their stance on rates, in other words,
Crazy.
where they're at,
Breaking below
that's
that
a good
channel.
sign. It gives you an idea that they're going to be obviously watching what's going on with the data, looking at the labor market conditions and inflation conditions, which are still good from an employment standpoint. Inflation is still relatively high.
A break of that
considering
tapering channel would have been
targeted
actually
mandate,
nice,
but they
nice
have
put.
they have basically real yields right now. In other words, real interest rates are positive, and it's going to take some time for core inflation to come down, considering shelter costs don't move down like commodities do quickly. So, ideally speaking, if the Fed doesn't raise rates or lower them, I think that's a good position to be in for the markets. I think earnings is really we have to focus on. I think there's too much focus on inflation, a labor market condition, what the Fed is going to do. I mean, the Fed is going to tell us exactly what they're going to do, so we can't change that. But I think at the end of the day, what's going to matter going into the end of the year is corporate profitability, and I think that's
similar to yesterday right now.
Focal point should be and is going to be.
All right, well, let's talk about
Same sort of aggressive selling.
profitability. Scott, what are your expectations for earnings seasons? Because we are starting with a few beats, but is it that expectations were so low and that they came in better? Or are you expecting a strong earnings season here?
Well, it depends on the sector. Now, I think that we should expect a stronger than we've seen earnings season, especially when it comes to the banks, especially when it comes to the bigger banks. Now, when the regional banks, we still got a little bit of struggle, perhaps in some of those. I'm looking at for example, a Zions Bank, a regional bank, and a couple of others that are just maybe not quite up to snuff with some of the larger banks. But in this interest rate environment, that interest rate's actually benefiting the banks, and so we're seeing that help them in terms of their increase of revenue and so forth. So I think from there we've got a good standpoint. I think we have a mixed bag in the rest. It's anybody's guess. We'll just kind of have to see how it plays out, But with the economic data that we've had coming out, that should be an indicator that the American consumer is still ready to spend. If the American consumer is still ready to spend, then we should see these things coming in pretty well, depending on how the companies
this is looking like
been managed.
Yesterday's.
So, I think we'll just have to see how it all plays out, Caroline.
Come a little
George,
early.
What sort of indicator is the lack of participation from small caps? Because
yes, yesterday was that engulfing candle.
Still down on the year. It's down on the week. We just aren't seeing interest there right now.
No, I think it's obviously interest rates are impacting small caps, which are more sensitive to debt conditions because they're a little bit more in debt relative to equity. The other thing is profitability. If you look at the Russell 2000, a large percentage of those companies don't have adjusted profitability, and I think that's why they're down, and they should be, considering again, higher interest rates, which are essentially two variables going against them, and I think that's one of the reasons it's down. And I think the rotation into value-oriented, profitable companies is where the market should be, where it's at right now, because of the fact that interest rates are still relatively elevated, and they're probably going to stay elevated for quite some time. So this whole notion of growth
if I left my
value,
stop,
I think that's
break even, I would have stayed in that put.
Right now because
there's just
the
one though.
interest rate conditions we're in.
That took the profits. I mean, who knows?
George
Could have if I was ready, prepared for the break of this. I prepared either way. I was just getting prepared for the upside, but I was anticipating the break of that tapering channel. Could have taken puts there, but I wasn't prepared for it. Yeah, AMC took a little turnaround. Yeah, 12 and a quarter. I mean, SPY flushed pretty good there too. Probably got a little momentum from that. So was that first pretty big resistance at 1073. Didn't like being above there yet. See if we can hold what, 910? 10 level? 31. A good lesson to remember. Doesn't always work that way though. When we had that head and shoulders, that's when I closed my calls. Somewhere on that right shoulder. I don't want to take puts yet though, because I thought we were still in this channel. But once we broke this, I could have taken the calls or the puts. But yeah, that's not even a good trade, because it would be just for this move right here to this lower channel. Yeah, then be a break of this one, but then you're just kind of winging it. Yeah, so there wasn't really a setup for me there. I wasn't ready for this though. Little wedge building there on SPY.
Sarge Guilfoyle will walk us through some trades later in the show. Eli Lilly, General Dynamics in our big three. Our 360 round will take us through the pulse of the consumer
low there on SPY
that we are watching. And first, we will kick it off with Jenny Horn to take a look here at some of the top market stories. And first, you're looking at one of the banks on the move. Jenny.
Break of the bottom wedge.
Right, Nicole, we're seeing JP Morgan continuing to benefit from these higher interest rates, continuing to benefit from some of the pretty lucrative deals it's made to take advantage of the collapse of some of these regional banks. So JP Morgan remains a winner with a nice pop today. Following its quarterly update, we did see that they did mention this geopolitical climate, and We saw Jamie Dimon actually say whether he was meeting with the other bank executives, he does plan to meet with them throughout the course of his works, but no emergency gatherings have yet been called, which I think was important because the rest of his sentiment was relatively negative just regarding the state of really, again, geopolitics at this point. He said, "We are all climbing the wall of worry a bit. That's our job," saying that the wars in Ukraine and the Middle East are affecting all global relationships and uncertain outcomes and uncertain timing. Banks have been preparing for a number of scenarios, including the soft recession, a hard recession, higher interest rates, and stagflation, which are all still possibilities in this market. While bond yields have climbed relatively quickly in recent weeks, Dimon did say, historically speaking, he would not put them in the high category. However, he did say that all in all, this is a pretty interesting time right now, to put it lightly, saying it's actually the most dangerous time the world has seen in decades. But again, this doesn't necessarily speak to the strength of their results. They saw revenue come in staggeringly above last year, beating expectations. Bottom line also beat and grew on a year-over-year basis. So numbers were objectively really strong. Jamie Dimon's comments, I think, were interesting, as he always has a good read on the overall globe and overall economy. But spending, he did say, does remain more normalized. Still, though, met with some pressure just compared to more normal, which I should put in quotes at this point, more normal times in the world here, Nicole.
Yeah, there is concern about margins, no doubt, as we look forward. In the meantime, another big story that we've been following is actually here, and that is Microsoft, Activision, Blizzard. Finally.
I know. I can't believe that we're finally discussing this. It feels like it's been about 2 years in the making. I think it's been a little bit less than that, but Microsoft did finally close its $75 billion acquisition of Activision Blizzard, the largest in the decade and the largest under their current CEO. The purchase, which did close on Friday, is the biggest deal in their near 50-year history. It took 21 months to get through the gauntlet of regulators. So the deal was completed after it did win that key UK approval. The UK's Competition and Markets Authority did say Friday that the proposed deal is no longer a major threat in cloud gaming. This was nearly 6 months after they first rejected the deal. And the shift does come as Microsoft has offered to restructure their overall takeover by forfeiting cloud streaming rights for Call of Duty, as well as other popular Activision franchises in much of the world. The streaming rights for Activision will instead be sold to French games giant Ubisoft Entertainment. The CMA did say this preliminary decision last month that this had resolved most of their antitrust concerns. So we had hopes for this deal to go through, but finally have actual confirmation of this today. The fact that we will not see Xbox now having a monopoly over Call of Duty, also seen as a win by like Sony and some of the other competitors. So all things considered, a huge win here, and we can finally put this story to rest here.
Yeah, and I'm wondering what Bobby Kotick is going to do next. He is a mastermind, so he never expected that he'd be selling this company. And look at that, as you mentioned, $75 billion deal. It's crazy. Thank you so much, Jenny Horn. Great to see you.
And
for some insights in the news shaping the markets, for that we welcome in Ryan Nauman, market strategist at Zephyr. Thank you for being here. We've had a wild week. Good points and terrible points. We've had a heavy heart kind of week. What do you think, though?
And fleshy. More fleshy flush.
And the NASDAQ, even with down arrows today, are higher for the week. What is it all telling you?
Hey, Nicole, thank you so much for having me on. You're exactly right. It just, it's a very complex market environment right now where the only certainty is uncertainty. Equities have rebounded the past 3 weeks as despite all the turmoil in
yeah, it's looking like yesterday's
that we're seeing
same type of move.
Experience. Equities have rebounded.
Pretty crazy.
In the past 3 weeks,
might get an end of day rally. I'll be ready for that.
Its rate hikes.
Even like yesterday, if I didn't catch any of the downside, just the bounce from the low was a pretty big move.
And I think investors are forecasting earnings.
So the fact that it's happening so much earlier, I have a nice rebound by end of day.
I mean, so far, what's your takeaway? Because you mentioned earnings season.
Looking out for yesterday's low, for the next support.
Revenue rising 14%. All these banks coming out and doing exceptionally well. I think people are impressed with what they're hearing from the banks today. We'll get more next week, of course. What is that telling you about earnings season so far?
So far, it's early, but it's something that higher yields, the tighter financial conditions that we're experiencing right now isn't impacting corporations and earnings as much as maybe we thought it might. But at the same time, usually it takes about 18 months for higher yields and interest rates to really trickle through the economy. So it remains to be seen exactly how much higher yields, higher interest rates are going to play a role in corporate earnings moving forward. But right now, especially with the banks are capitalizing on the higher interest rates despite a very deeply inverted yield curve during the quarter. Banks are capitalizing on higher interest rates. And I think moving forward with earnings, focus on the narratives, not so much maybe do they beat or miss. Focus on the narratives. What are these corporations going to do? How are they going to contend with higher for longer interest rates? Are they prepared for higher for longer?
Yeah. So tell me about portfolio diversification. That's something you're telling investors about today. That's the way to go. Maybe even looking at alt investing.
Accelerating a little bit here.
Give us some ideas that you're telling folks these days.
You know, like I said at the beginning, it's a very complex environment where there's so much uncertainty. And with that much uncertainty going around across the globe and here within U.S. soils, we have a U.S. election coming up.
IV's got to be picking up.
A Fed policy mistake potentially
VIX,
on the horizon.
all that. Yesterday saw off, now this on today.
Portfolio diversification
Market's starting to get pretty
is
volatile.
very important. And that makes,
that's fun. It's good
I'm
for trading.
not just talking about bonds and equities. We have to look at outside that your typical asset classes and look at alternatives, potentially private credit. Private credit is an attractive space. Look outside the box there to reduce your correlations, increase your diversification in times that are so unknown. And for investors, really focus on the long term. Yes,
got a bear flag there on
it's
room.
hard to focus 2-3 years down the road, but that's what's important. And don't take too huge of bets moving forward. Look at separately managed accounts in order to gain access to alternatives. It's a great way to use managed accounts, professional active management to gain exposure to alternatives moving forward.
Yeah. We talked about yields, we talked about diversification. Obviously, the uncertainty is present, and you are seeing the safe haven of gold, for example, up nearly $50 today. Oil also moving higher. Any thoughts on commodities?
You know, commodities are always, they're one of those ultimate hedge plays, right? Especially like the dollar and gold. And, it's one of those, if you're really concerned about markets moving forward and what's going on in the Middle East, it's a good play there to really diversify your portfolio and add the ultimate insurance to one's portfolio. So it's an asset class that one should consider, especially if
40 minutes
if
to
you're
you
really
close,
concerned about the
20
well-being
minutes
of the global economy and the U.S. economy.
Right, understood. Thank you so much, Ryan Nauman, market strategist at Zephyr. Thanks, Ryan. Coming up next, we have the big three. There's plenty more here on Trading 360. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals.
Lichtenstein
standing by. He'll have trades for CrowdStrike, Eli Lilly, and General Dynamics. We'll be right back. Schwab Network continues.
CrowdStrike, they've made great strides in their business last couple of years. Arguably the best-in-class cloud-based cybersecurity firm, along with Palo Alto Networks. I'm long both, by the way, and Zscaler, which I'm not long. Will not report their third quarter until November 29th, so you got a little while. They're looking for an adjusted EPS of 74 cents on revenue of about $777 million. That compares to 40 cents a year ago on about revenue growth of 34%. Out of the 37 sell-side analysts who cover this name, 37, that means all of them, have increased their estimates for third quarter revenue over the past 90 days. Going to look at the chart, the stock has been in an ascending price channel pattern since the start of the year, consistently rallying off of its 50-day SMA. This pattern is a pattern of continuance until it breaks one way or the other. In other words, investors like myself ride these patterns for as far as they'll go. Relative strength is quite robust, as the daily MACD shows strength as well as all three components of the MACD in positive territory, and the 12-day having now moved above the 26-day.
So FG's coming due? Yeah, I was looking at Siri earlier today, actually.
Pivot, it's moving,
Oh yeah,
but right
little
now it's
bounce up there.
$206 because it's the upper trend line. My add point is down to the 50-day SMA, currently 171, and my panic point is $160, which is where that lower trend line is right now. So that's also a moving price right there.
Yeah, understood. So what do you think here, Ben? I know we took a look at CrowdStrike yesterday, but Sarge always brings a new perspective.
Yeah, no, Sarge mentioned this one's made some great strides, and I think the price activity as of recent reflection thereof. I've got a 30-minute candle chart here behind me, and you can see throughout most of September, we're very much sideways, right? And then you can see also some high conviction as we've rallied out of the range that we had been in around 166 recently. What I like about this chart is it really shows the two phases of development, right? You have that sideways consolidation, overlapping, rotational phase that doesn't exhibit a lot of conviction one way or the other. You test the upper extreme and the lower extreme a couple times, but for the most part, price is very random within that. And then you get that really high conviction phase to the upside where the market breaks out of this range here. What we're waiting to see is, do we form another new area balance at this upper level? That's exactly what the bulls are looking for. Now, as I take a look here, I also want to step away from these intraday charts. I want to try and figure out where we are going on the bigger picture. In this instance, you can see it's very well defined at the upside as we look at these areas of consolidation, which continue to form at higher and higher levels. Again, we were just talking about this one around 166, the breakout that we've seen, the high conviction vertical phase out of that horizontal overlapping random rotational phase. And as long as we hold, well, while in that phase above 150, we were okay. Now, again, we're waiting to see if we can balance at this new upper level. And then in this instance, 166 becomes the line in the sand in terms of the area the bulls don't want to see it below. But yesterday we were talking, Nicole, about this instance, as you mentioned, Sarge. We looked at this yesterday, and what I was talking about how is these areas of value that I look for, they help us determine trend, but they can also help us determine trend no longer being present. In this instance, it had been to the downside, right into those October lows that we saw, the lows that we saw last fall into the end of last year. And then look, as we came out of that balance, 115, this move that we've seen and we just recently mapped out and through 186, again, a significant move is because you could see that also coincided with that range that we had been in the summer of last year. So definitely a big move up here. It's significant, and there is some momentum behind it.
Right, okay. So you talk about this momentum, Sarge. How quickly you think this could all happen?
Oh, I mean, this is when it's in a pattern like this, you really can't tell, because this is one of those, the whole area, the whole cybersecurity area is overvalued relative to the rest of the S&P 500 because we're betting on future growth. So these are very hard names to value. So what you have to do is you have to be able to play the technicals, play the fundamentals, and play momentum. You have to be very well-rounded to trade these kinds of names, and you have to recognize when the moving support and moving resistance, because they're both rising at the same time, when you're closer to one or the other, because that's when you adjust your exposure.
Right, okay. Thank you for that. Let's turn our attention over to Eli Lilly, a different group, completely different.
Yeah, completely different, but it's going to be a similar chart. All right, Eli Lilly is trading at 47 times earnings, which is really expensive for a pharmaceutical, for big pharma. All right, what we're doing is pricing in future sales of the diabetes, probable weight loss, probable kidney failure treatment Mounjaro. I said that incorrectly. The drug has so far only been approved for diabetes, is believed to be very close to being approved for weight loss, and will probably be tested soon for kidney failure. Second quarter Mounjaro sales grew to $979 million from only $16 million the year prior. Earnings are expected for Lilly on November 2nd. The street is looking for $2.90 on revenue of $8.9 billion. This will be up from a year ago, EPS of $1.98, and the sales growth number will be 28%. Over the past 3 months, of the 12 analysts that cover this stock that I have found, only 8 have increased their estimates for revenue generation. So this is going to take a little time to really get the ball rolling from here. Taking a look at the chart, this, as I said, this is another stock living inside an ascending price channel. Relative strength has moved from weakness to strength very quickly, as has the daily MACD. All 3 components are now in positive territory. The 12-day has reasserted itself versus the 26-day. My target price is $718. My pivot is 625, which again is moving because it's the upper trend line. My add is the 50-day SMA of 551. And my panic is just below that, 550, which again is a moving target because it's the lower trend line.
Okay, so that's good that you know where to be most careful, those levels to watch on the downside. Ben?
Sarge is right. It is a very similar chart, not only because we're trending higher, but we're also in and attempting to break out here right now, getting to a vertical phase in a couple of the bigger picture time frames. But let's begin with just the move we've seen since the beginning of the month. It's been very well defined. We're talking bottom left to top right. We were trading down around
looking for some puts, maybe.
And we've topped out recently all the way up around 630.
Get the last little bit maybe on this move.
Significant move here is this occurred over just a very short period of time. Looks like the ball is starting to roll here, Sarge. I went ahead and I identified some of the areas of consolidation that have formed because there's been pauses along the way up here, right, where the market has just kind of held and then kind of regained composure. And these are the areas that we use to reference whether we're continuing to see trend in this instance to the upside. And it has been, right? Currently balancing right around the $610 level. So I don't think the bulls want to see this below 572-ish, we'll call it. The structure is not as nice and easily well-definable as I'd like it to be. But you can see, again, bottom left to top right. It's tough not to establish that, right, in this instance. Easily identifiable trend here. Looking a little bit of a bigger picture, 4-hour candle chart. We're going back to the end of February, beginning of March, and we were down around that 300 level. You can see these areas of consolidation continue to form. It's not just on the 5-minute. This occurs across all time frames, all products, bull, bear, trend. I mean, and in this instance, you can also see what I was talking about, the vertical phase, the breakout right now. This is a high conviction phase. We're looking for energy follow through, higher highs, higher lows, and we're getting that, right? You can see that through this trend environment to the upside. The momentum higher, a little bit more time on this chart shows that we've been trending higher since, well, back in 2020, this stock was trading around 130. And then again, these areas that formed at a higher levels, just sort of solidifying that working assumption. You can also see the significance associated with this breakout because, again, we're now in a vertical phase. The bears want to see us sustain this upper level price activity and at some point establish a new area of consolidation at a higher level. But there's some energy here with this one as well, and there's a very well-defined trend to the upside, and we're in an easily identifiable initiative phase here.
Yeah, and so that's the point. What do you think here? Final thoughts on this one, Sarge, on Eli Lilly?
It's really all about the success of Mounjaro. Jim Cramer, who you know well and who I used to work for, has called Mounjaro possibly the greatest selling drug of all time when it's all said and done. So it's really, although they have a lot of other drugs in the pipeline, and it's a big company even without that one name, that one potential drug, which is already a drug for diabetes, is going to be the one that makes this the breakaway pharmaceutical of the industry.
Yeah. All right, so let's get, obviously UBS and all of Wall Street has been talking about the defense stocks, and UBS saying, look, U.S. defense companies likely to benefit from rising military spending. We know the geopolitical concerns we're facing. Week-to-date General Dynamics is up about 9%, but you look at Raytheon, Lockheed Martin, you know, every single one of those is jumping this week. Your thoughts on General Dynamics, a name that you often pick. You often stay with some of these defense stocks when you're on the show.
Wasn't one there.
Yeah, I've been on the show.
Gonna be pretty tight on it.
And Northrop in the past.
Stingy.
And now we're going to talk about General Dynamics. I'm long all 3 of those, by the way. GD is the current manufacturer of the M1 Abrams main battle tank. It's the manufacturer of the Virginia class, that's the latest class, of nuclear-powered submarines. Attack submarines, I should say. And most importantly, because this is what we're short of right now, they manufacture the M1128 155 millimeter high explosive howitzer round. All right, the Ukrainian army's out of them, NATO's out of them, the U.S. Army's almost out of them. So this is a severe shortage here. The Army just signed them to a $974 million contract to make howitzer rounds, which, if you know anything about the kinds of contracts, that's really expensive for should I call them stupid munitions or dumb munitions? You know, usually that's those kind of price tags are say for higher price items. All right, earnings are expected on October 25th. Wall Street's looking for $2.94 on $10.1 billion. That's not out of sight. That would actually be a slight contraction in earnings on 1% revenue growth. This is about free cash flow and the expected
low of
pop in
today,
demand
and then
that will follow the U.S. Army's
low of yesterday.
contract. All right, this firm so far for the half year has generated $1.82 billion of free cash flow, and will probably generate more in the second half. Looking at the chart, I'm going out on a stretch here a little bit, so this may be where
I'm
Ben
not sure we
gets me a
break
little
it
bit.
yesterday as well.
I'm trying to play chess
I don't
and
know if we'll get to
anticipate the
yesterday
next
as well.
move. One can easily see this cup formation that starts back in November of last year and stretches into October of this year. Now, I'm thinking here, after this little gap that would need 224 to fill, that we create a hammer, create a handle off of this cup.
Maybe.
So I'm going to have a
Be a
couple
big
of
day
prices to
again.
throw at you. Right now, the pivot is 256 because the pivot is on the left side of the cup. If we get this
that'd be
handle,
crazy.
the pivot will trade down to will move down to 240.
Could be. I mean, yesterday was that engulfing candle.
It slopes downward. That would take a target from 295
I'm kind of expecting
down
more
to
chop and maybe
276,
some more upside
which I
even.
believe is much more achievable.
But
all right, my add point is going to be from 228
that gap doesn't
down
have to get filled right now.
224. And my
See you in
panic
2024.
would be a break of that 50-day SMA, which is currently $222.
Right. I love how you give us all that. When we talk cup and handle and we're looking at your projected price targets, and we talk tanks, submarines, and explosives, we're paying attention. I love it. I couldn't love it. I couldn't love it any more than I love it right this second. Ben?
Yeah, I like those
You're
levels
close.
as well, Sarge, especially the
I'm not
256 area.
calling reversal
That's key,
yet.
I think I'll show you why in just a second when I pull a longer-term chart here. But Sarge is talking about a pop in demand. We've seen a pop in price, that's for sure. You can see it behind me in terms of the more intermediate, or I should say more
Could be double
granular
bottoming
time
here.
frame. We are looking at a 30-minute candle chart. You can see the sideways consolidation again, and then the separation. And you'd see the two phases of development here as we look at this chart. It's pretty well defined, and then again,
Guess
as
it'd be
I look
bullish
at,
if it doesn't. SPY
the
doesn't
area that we're forming
retest
right now,
yesterday's low.
Actually, let's just move away from this. I
Keep
want
us
to show
in
you
an
what's going
uptrend.
on here with a longer-term trend that's playing out here. Again, 4-hour candle charts now in this instance. Definitely well-defined to the upside. You can see this is the move we just looked at, the high conviction phase, the vertical phase to the upside out of that range we're in around 221, and then you can see the balance now forming pretty well-defined here up around 238. I want to show you also, as we get into those levels that Sarge was talking about, the potential
There's a new
cup
low
and
on
handle
SPY.
forming here. That's that high he was referencing from last fall up around 256, which if you notice
Now down
actually
0.5%
coincides with
on
highs that we
those.
saw in the beginning of 2022 as well. So this is an area that
AMC
you want
fleshy,
to watch here. We're starting to build
14.5%.
momentum through the
Wow.
middle of this range, this balance area again around 238. We've got some pretty well-defined lows down here also, but as long as we're above 197, we're still in a trend environment to the upside, attempting to get above that 256 level. If we do, we're going to look for a breakout
we
to the
hold that
upside.
level,
Sarge, you mentioned then your pivot, I think you
910.
said, would move up to 240. Well, you can
Looking
see my
for-
pivot again right now at 238, basically $2. That's right in that same range here. So I think Sarge is onto something here, not only in terms of this name as far as what's going on here with GD, but also with the two other names that we looked at, both very well-defined trend higher.
Thank you both so much. It's great to see you both on this Friday, and appreciate it. Big three, always so great. Stephen Guilfoyle, we call him Sarge, Sarge 986, and our own Ben Lichtenstein on the charts. Thank you both.
Lichtenstein.
Right, good luck. CrowdStrike, Eli Lilly, and General.
I like that
Dynamics.
channel. See if
Coming up next, a spotlight on Microsoft Activision Blizzard deal. Caleb Silver is standing by to give us that and some tech
see if we
news
start
on our
rounding
radar.
rounding bottom here. Bottom rounders. I don't know. I'll look for some more profits at the low here. Fidelity is so slow. I was trying to go take some more profits and it just takes so long. So I have to go and modify my stop loss order, turn it into a market order, change the quantity. Alright, it's dumb to keep complaining about it and not do anything to fix it. My best not to. I can fix it, I will. It's just truly not meant for trading. Maybe Active Trader Pro is. That thing is... Goodness. Be a scientist and know how to use that. $9.34. See, bounced off that. I got a bad exit on SPY because of the time it takes. Okay, let's see. This weekend I could transfer. I could just transfer some funds. I don't know. No reason to be in Fidelity. Close to stopping me out. Should have a better exit there. Trying to break that upper channel now. Probably stopped. Not yet. Might be starting to round the bottom. Called. Oh, he had the flush. He was slow playing me. I think I'm stopped out now. Yep, out of those. Oh well. Took a little profit. Maybe starting to show the sign of reversal. Potentially. Tough break for that guy. Hit the flush at the full house. Is a hidden full house too. He didn't. The EU closed, what, 4 minutes ago? Hard. Didn't get yesterday's low, but we're still in kind of an up channel. If that continues to be the case, suppose a break on tapering channel would be bullish. The reversal. I'd like to see another test down here though. That's Bays. Whatever. Give you the chips. Give them to you.
Better readers, and they're as cautious, Nicole, as they've been all year. And cash seems pretty comfortable right now, especially when you're getting 5 to 6% at the bank. You're getting yields, high yields on bonds, but people are not that interested right now in government bonds. They're interested in protecting their cash, worried about another potential sell-off, another leg down. Even though this is the seasonally strongest time of the year, they're still pretty cautious right now. And because there are alternatives, and they're pretty good alternatives at the bank, why make the risk and delegate more cash to the stock market when there's so much uncertainty? Last weekend, obviously tragic on so many levels, but also adding that layer of uncertainty kryptonite for investors. Hang out in cash, see how the rest of the month plays out, see how things look through this earnings season, which is just kicking off right now. We'll hear from the big tech companies in the next couple of weeks. Then they'll make a decision whether or not they want to get back in. But right now, things seem a little scary, so there's no harm in making no decision about allocating new capital to the stock market, kicking back in cash right now, buying a CD, a money market fund, or a money market account, and waiting until see how things play out.
Yeah. What about earnings season? When you think about the anticipation of what we can see, your thoughts?
Yeah, this could be a catalyst, but I don't think it's going to be a major catalyst like we've hoped for in the past, just because of all the economic uncertainty. Obviously, you have the potential for another government shutdown. You have what's going on in the Middle East, Russia, Ukraine, obviously oil, so many factors right here that could present walls of worry and obstacles for a catalyst for the stock market. But as you know, it all depends on what happens with yields, government bond yields, and the dollar. If the dollar keeps falling, stocks are going to continue the rally they started a week ago. If the dollar strengthens because of this concern and yields keep popping, well, they're going to sit out and watch these alternatives continue to play out, keep putting money aside in cash, not invest it right now. The good news, there's $5.6 trillion in money market funds right now that's just waiting to be deployed into the stock market. The bad news, there is no obvious green light or catalyst for that money to rush back into equities at this time.
All right. Caleb Silver, great to see you of Investopedia. Thank you for always making sense of things for us. Coming up next, the disruptors. George Still is standing by. He's watching Palo Alto Networks. KeyBank raising the price target here. And so we'll want to learn more about that.
I might be breaking that top a little bit. I'm gonna be patient on the calls though. Bottoming and reversing will take time, slow process, lots of chop in between and potentially never even completing it. Someone has diamonds. A lot of people have a flush. Queen, that's not bad. As good as the ace though. Straight flush? Ooh. Wow. Wow. Ace queen, 3 queen. We should have this. Oh, ace. Of course. Of course. Of course. Pocket kings next up. Now they'll really think I'm tilting. I know how this game is sometimes though. I think it favors a lot of all-ins. Loose play. Oh, they didn't. They believed me this time. Bad Market Friday. Poker early morning. I'm waiting for the setup. I've traded some today. Some gains, some losses. I think I'm slightly green. Pretty neutral, which I'm fine with. I'm going to go slow. Set up maybe for some calls by end of day. Market's sold off. Pretty good amount though.
Trade.
So in this case, Nicole, trend continuation, if you just look at the financial performance and the metrics, they all line up to a continuation of the trend. And I know it sounds, counterintuitive saying, hey, we missed out on moving opportunities in the stock, but it can continue from here based upon the earnings power the company has. So going into what's going on with the market today, we're seeing a little bit of a give back after some of the highs earlier, but we can trade this going forward by
Could get
placing
some puts
a
here.
December bull call spread.
Not
So
a
we're going
great
to go
risk
out
to
the December
reward.
monthlies and buy the 260 calls, and then simultaneously we'll
becomes a
sell
good one,
the
but
280 calls. So it's a $20 spread, and we're basically outlaying $8 a share or $800 a contract. So the whole objective is obviously for the stock to continue moving to the upside between now and December's expiration in 64 days. And 268 is the break-even price, which is again about $9 off the current price of the stock. And of course, max profit is going to be $12. That's assuming again the stock hits 280 or higher between now and expiration.
Got me straight.
I see. All right. What's the big picture on the week that was? Any thoughts? Or week ahead? I mean, we got a lot of earnings already, but what are you thinking?
Good.
Well, I think looking at today's market activity, I'm not too bothered by Nicole because overall the week was really good. And if you go back to the FOMC meeting back in September, we've recovered nearly all the losses from that meeting. So I think overall, as long as interest rates stay where they're at, I think that's
could have been a little smaller in that last one. Seemed the straight could have come out.
The end of the year, but we're obviously seeing some
been
profit
better.
taking, particularly today. If you look
Putting
at
up
some
for
of the
a
big
fold,
cap techs like
a
Adobe,
raise.
Google, Meta platforms, they're trading quite a bit to the downside and maybe some profit taking moving into earnings. But overall, a negative day, obviously, but I still think we're going to be higher by the end of the year.
Okay, so Adobe and some profit taking there on some tech names. I saw basically the Magnificent Seven were lower, but it's still a winning week, even with the down arrows today, to
That's
your
right.
point. Good to see you, George Sillis. Thank you always, every day.
Georgie boy.
George Sillis. Coming up next, our 360 round.
Yeah, looking maybe to grab some puts. A little head and shoulders, top of this potential tapering channel. Yeah, I got some. I think. Yeah, look at that.
I remember when I first started flying.
Take profits probably this low first. A little bit more at this low, and then stop out the rest. There's a little interim trade while I wait for the market to build liquidity to maybe go back up. Command and Conquer. Big bouncer on Groupon. 13.8. I don't know what the sell-off was even from. Never heard. Reason. raises. Okay, let's buy. Upgrade from eBay days? Talking about. Taking a little off there. On slowdelity. There you go. Like that. Spy me to sell a little bit. And it'll make its move. This is the way. Close another one there. Just fold that. Oops. Little scalps are working out all right. If you're bouncing this channel or eventually on yesterday's low. Close another one there too. We do respect it too. I'm gonna start looking at some calls. Still pretty early. What is it? Almost 12. New low there on SPY. Vocals for your favorite tune. Could have bluffed on that one. Could have bluffed on that king. Dang. One of these guys has to have a king, right? Yeah. Jack ace, better kicker, no way. Should've bluffed on the king. All? Alright. There's a flush. Broke the channel. On. Sell another one of these puts. Wow. Look at us go. That's breaking through yesterday's low. I think it's gonna last. Closing one there. Went all in. Oh, I guess I lost. Out of most of them, yeah. I have one for the homies now. The trailing stop. The stop. Let's see here. Interesting. Could have held on to some more. Just don't like the risk reward after we've come down so far and hardly had a pullback at all today. Halliburton. Halliburton. Got earnings coming up. So unless you want to play earnings, I wouldn't be shorting it. But yeah, you do have a historical resistance there. Maybe bust through there though on earnings. That would be my only thing to look at. Probably wait for that. Potentially it comes down before then. A bit. Not sure how this moves with the market, but more often that stocks rallying to earnings, but it could sell off as well. Huh. $13.5 on AMC. Holding that 930 level so far. In a starter position on calls. Starter. Still have my one put for the homie. I folded. What's RAD doing? RAD's down 7.6. Dude, raise? Oh, I didn't realize you raised. Gotta have a king, right? I wouldn't raise, I didn't realize you raised. Hold, shut up. Just been giving it to you.
Could be a very volatile weekend in terms of geopolitics. So when I look at the numbers scream me the dollar's up 2, but the dollar's only slightly higher. It's those 3 big risk-off metrics that we talk about all the time, Tom, I think are popping up on the screen. Look at gold, up $53 today. So strong risk-off metrics tell me that the world is getting jittery, Tom.
I'll get some more calls on the break of this top channel.
1900 an ounce there.
Might even close some or two actually first.
Needed to evacuate
close
over
some,
1
wait for
million
the break,
people
get
from the
some more.
northern Gaza Strip down south, and I just don't know how that's going to happen as they potentially ready for a ground assault here, Kevin. Definitely throwing a wrench into the equity markets today. But one of the stories coming out this morning was a downgrade of Netflix. Let's bring in Jenny Horn, markets correspondent here on the network, to break this down for us. Jenny, you know, I saw the downgrade. They didn't have a price target. But they had another story out on Netflix where they're going to open up a mix of retail dining and live experiences. What's that all about, Jenny? Is this going to be like another Universal Studios? Is it going to be, Rainforest Cafe? What is this?
I wish I was going to be a Rainforest Cafe. This is the most bizarre move I can recall from a company. The fact that Netflix is planning to open these locations, like you said, where fans can, to quote them, immerse themselves in their worlds of favorite TV shows, as well as shop for clothing and eat themed food. I mean, I can't even just make out what this is going to be. It's so bizarre. These locations are intended to be called Netflix House, and they will feature a mix of retail, dining, and live experiences. The company's VP of Consumer Products did say this will be the company's first permanent locations. So really bizarre. I mean, I would like to go to one of these things just see what it's like, because it's not a movie theater.
Okay, rallying
but
up
it's
here.
also not a restaurant, but it's also just not a retailer.
My put's still
it's
there.
so bizarre. I saw this headline last night and was like, what in the
Balls
world
are doing
they
all right.
thinking? But nonetheless, we do have earnings next week, Wednesday after the closing bell. Analysts with some negative sentiment today, like you did mention, Wells Fargo reducing its price target to $460 from $500 with an overweight rating, saying the company will be investing in its advertising technology and content, which will then in turn reduce their margin expansion, but also accelerate their revenue. So sort of like two sides to look at there. The firm does have below street estimates for their upcoming guidance and says they're patient buyers still of shares. Wolf Research also did downgrade Netflix today to peer perform from outperform, no price target, saying Netflix's growth forecast for the next couple of years looks risky. And this analyst went on to say they're concerned about reports of slower than expected adoption of the company's advertising supported tier, as well as signs that members might be trading down to some of those lower priced plans, which I think if you offer them, of course you're going to see customers trading down. Right now there's about 200 streaming services out there. It's getting very costly. It's more expensive than cable at this point, and there's just so many different offerings, and they're trying their best ways to gain consumers. Netflix does still, I'd say, remain king as far as its reach and its scale. But they did have some people that I'm sure left were not willing to then pay subscriptions once they were kicked off. I'm speaking from personal experience there. But Netflix shares have pulled back pretty considerably this month. They're down about 27% from 52-week highs. It's even more painful when you zoom out and you see that we're down about 50% from that all-time high, which was right around $700 a share.
Dish is red.
Jenny,
couldn't hold the gains.
You know, the new term is Netflix and fill in the blank, right? And they keep changing what that is. Now it's going to be Netflix and go to a restaurant for Netflix. And here's the thing. I understand this analyst, right? This is why Tom and I, and I'll just speak for myself, this is why I'm so cynical about analysts. The stock's $90 off its recent high, and now, right ahead of earnings, you downgrade it. I think this analyst, Jenny, needs the Netflix and chill.
I agree, Kevin. Maybe Netflix and chilling is reserved for the privacy of your own home. I don't think anyone should be doing that in these public locations they're launching. But I agree.
I don't think he knows what it means.
Seems like the theme of analysts right now regarding Netflix's upcoming report is they're speaking out of two sides of their mouth, which I guess is the theme for a lot of analysts. It's not just Netflix specific, but it's like you downgrade shares, but then you still have to add in that asterisk that, oh, we still see this as an opportunity long term. We still see this as a great company. It's like, make a commitment here. I think that right now subscriber growth will be so much in focus for Netflix. Obviously, that's a key number when they report. Guidance will also be very important. And I think any update on the strike, because they need content now. Their pipeline is drying out with all of these, continued strikes that have affected their ongoing production. So what does that look like now for the long term? Something I'm curious about. But I will say that Netflix, while it's not cheap, it does still have like the most newsworthy, noteworthy shows. So they have that attraction. It's one of those things where Netflix has become sort of like the idea of streaming when you think of different streaming services. So they do have some loyalty. Not to me, though. I've been Netflix free for like 2 months now.
Oh boy, you would like Rainforest Cafe. I mentioned that, and of course you get all excited. They closed the one in Chicago, Jenny. I'm sure you were sad about that.
It's a Chicago staple.
It's
or
gone.
It was.
It's gone. Yeah,
Flush.
Thankfully. All right, thanks to Jenny Horn, markets correspondent here, breaking down the Netflix story. But now let's bring in Joe Mazzola, Director of Trader Education at Charles Schwab. Joe, I wanted to get your take here.
For the full house,
it
but
seemed like the
was out there
reversal
so
today
early.
in the equity market was all based on this survey.
One more spade. This poor
it's
guy.
a small survey, but I think the highlight was the fact that the inflation expectations really rocked higher on this one.
Now, before I get to that, I got to let you know that my first Thanksgiving in Chicago was spent at the Rainforest Cafe because I burnt the turkey that I was making for my parents on their way down. So, yes, it's got a place in my heart. All right.
There you go.
On to the important stuff. Yeah, look, I mean, the inflation expectations came in way hotter than expected. I mean, it's been something that has been, moving in the right direction now for a while. And you see that big spike. I think the market in general is just trying to find some footing. Kevin hit the nail on the head. I mean, the VIX is up almost to 20 today just because of the geopolitical risk and kind of what we're seeing in the markets.
Yeah, last couple
yields
days
are coming down. Right now, there's so many different headwinds that are hitting this market. We got a nice little bounce last week. I think Kevin and I were on at the same time when we saw that nice reversal. We hit that 200-day moving average on the S&P, and things were looking a little bit rosy. But it's going to take strong earnings to keep this market momentum going up. We got good financial earnings today, but it's just kind of kicking it off, right? It's we have 50 of the S&P 500 names coming out next week, so we'll get a little bit of better insights into what the earnings picture is going to look like.
Yeah, I think that should probably be the focus. But, Kevin, you mentioned that risk going into the weekend on the geopolitical side. That's definitely going to be a concern for the equity markets. That's why, as you mentioned, that push into those safe havens ahead of the weekend here. But, you look at those earnings out of the banks, and they all look pretty good. I mean, whether it was, Citigroup, Wells Fargo, and then J.P. Morgan. J.P. Morgan actually did trade down to 144 right after the release of the report, but then spiked higher. I mean, Kevin, what's your takeaway from that? Because it seems like maybe the sentiment was too negative on the banks going into these results, and that's why you're seeing the pop?
Well, it's interest rates, it's the yield curve, it's so many things going on with banks. It's geopolitical risk, which Jamie Dimon, here's the quote of the day. Caroline Woods and I were talking about this earlier. this may be the most dangerous time the world has seen in decades. I think that put that tone out over the markets when Jamie Dimon said that this morning. One good, real positive from the banks, the loan losses. I mean, JP Morgan put $1.38 billion aside for loan losses. They thought it was going to be $2.3 billion. So those numbers are coming in really lighter than expected. These banks have shown a real ability to manage their risk, at least the big banks, right? And so their numbers were really good. And then the net interest margin numbers, Tom, with rates where they are, $22.9 billion out of JP Morgan. That's just in net interest income. That's incredible. Wells Fargo had good numbers there as well. But yeah, banks, solid. And even Jamie Dimon said solid growth, solid earnings this quarter.
Yeah, he did mention the fact that the consumer is still resilient, Joe, at this point. But then I just read the Citigroup CFO stated that they expect a mild recession in 2024. And then the Wells Fargo CEO did come out during their conference call and said that
Friday we're
going
gonna
to
do a whole
trends,
screen,
but it seems
whole
like
side that was poker.
they're being a little bit more
Poker Fridays.
efficient on that side, and
Look at that! Look how
expectations
big
weren't
that
too
is.
high going into
You see
these,
that now, Jay?
reports.
Now, I think the critical
My eyes are
factors
bleeding
to
looking at
keep an
that
eye
big
on
of a
for the
thing.
Financials for sure will
Can't even
be,
see what I have.
Spike in the
Big.
10-year Treasury yield has affected capital levels,
Big.
and then the activity in deposits. The big banks, the ones that came out today, they seem to be a little bit more sheltered from that than what you see on the regional side. So that's going to be key in my mind, keeping an eye on that. But it's not just the consumer that is affected by this spike in yields, and I think something to really kind of keep an eye on over the next couple of weeks, guys, and something that I'm really watching itself is the small caps, the Russell. It's really started to break down. I mean, it's been doing that really since August, but if you look at the Russell 2000 and on 40% of the companies within the Russell 2000 are non-profitable, boy, it's going to be more and more difficult for them to kind of cover some of those interest coverage ratios and make those debt payments should they need to refinance. That could be one of those kind of canary in the coal mines to kind of keep an eye on as this earnings season really starts to pick up.
I'm out of the put.
Earnings going into the small caps.
Barely got to it, didn't
there's
it?
the chart on that. This thing has been pretty dismal,
okay.
Getting near those basically five-month lows.
Starts reversing
once
back down
again.
now.
And it was strong earlier on in the week, but we've seen a pretty big fall over the last couple of days in small caps. And historically,
my
Joe,
calls.
I'm with you. I typically watch the Russell because it's got a little bit
dips.
higher beta. Maybe it leads the overall market. Maybe it reacts a little bit quicker. But Kevin, going into next week, we've got more earnings coming out, more financials in that aspect, and data kind of relatively light. What are you focused on for next week?
We need to get through this weekend without any major geopolitical issues. I think everyone will be on pins and needles watching the news for any story breaking there. But next week, more financials, right? Bank of America, Goldman on Tuesday. More airlines, United Airlines, American Airlines, Alaska Airlines. And then we start creeping into large cap tech with Tesla and Netflix during the week. So, yeah, we're creeping out of that first stage, which is airlines and financials, and we're getting into that big, important second phase of earnings, which is large cap tech, Tom. So, yeah, things are about to get real interesting here.
Yeah, those airlines will be of interest. Most of the majors are down about 7% so far in October. And then you've got oil spiking again today. That's probably not going to help their margins whatsoever. All right, guys, let's take a quick break here. When we come back, we're going to take a look at our first chip name, and that's going to be AMD. It's risen about 65% so far this year as traders increase their bullish positions in the semi sector. Fast Markets coming right back.
Okay, I'll play along. 8-9 suited. See if you find support here. Wrong red card. quads. Has a pair of kings. Gosh. Yeah, nothing. $14.25 on Groupon. Legit bounce. Oh, Looker House. It's only down 27% today. More insider selling. More share offering. Congrats, I hope you got out of this thing. Public offering. This is insane. 19 cents a share. What are you doing? You just IPO'd like a month ago for $4 a share. Now you're having an offering at 19 cents. Make it stop. At least do something nice with my donation. Get to the top of the channel here. And a break. Get a little retest. Not the retest. Oh, retest. That was the retest. I got some more calls. I could still scale in more if we come back down. Nice little inverse head and shoulders here though. Looking good on this account. Pretty big position sizing for this one. Oh. Another opportunity to get some more. Maybe. But pretty early, it's only 12:20. This inverse head and shoulders, I like the tapering. Like that retest. Got some more. Okay, I'm good now. Satisfied. Might get another retest down here, we'll see. I like the channel break. At the least, potentially move just a VWAP. At the most, break the highs of the day. And keep keep on rallying. Keep on rocking in the free world. I like that. Got that 1K shares out of 25 cents for a 1 cent gain. Wait, what are you talking about? Oh. Wait, what were we talking about? Oh, liquor. 50 to watch dwindle, nice. I didn't look at the details, but yeah, it's one of the worst performing IPOs ever. And continuing to break that record by massive sell-off, 90% maybe, and then offering shares. Are they tripling the float too? I didn't look at even the float size. 5 million, now they're offering 58. Whee. Okay. I went pretty heavy on these, so I'm gonna be pretty close. Closing one there. Close a couple more there, I think. Close 4. At the top of this little deal. Distance up here. And now put a stop on the rest. Not that up on them though, so I'll probably get stopped. That happened. I'm trying to bring my small account back from the grave. At $73 buying power. Got my daily call. Small account challenge engaged. $2,000 was too much for small account challenge. I needed $78.15. This is the way. Nice, give me a little cushion. Can't get married to it because we very well could just be building liquidity for the bears. The bears. So, VWAP. Actually pay attention here. To some of these channels too. Let's see. Yeah, because my starter position was so small, and then I added. It was a long time till I added. My added was pretty high. Ah, yes. I might even take some more profits at this channel. Some at VWAP. If we're bullish today, we're going to probably climb all the way back up to the high of the day. Be a nice big intraday move. You gotta feel the pressure to appreciate the challenge, yes. I'm only trading one contract on the small account. Taking a little more off here. This resistance is acting like resistance. Put a stop on the rest of these. Probably get stopped out. It's still pretty early. It's only 12:30. You very well could retest. 431.60 again. Oh. That an initial first bit, it's like once you've gotten to the position size you like, it's like, ah. That's awesome. Guts. I don't know if I've ever played poker at a casino. No, I haven't. I've rarely frequented casinos. I'll psych you up. Alter egos. Milakami de Idili. What language did I learn today? It's crazy how much dailies do compared to... So I have dailies on the small account. I have Mondays on the big account. They're only up 5%. The dailies are up 18%. Yeah, I think also probably because they're Mondays, they're not tomorrows. Probably moving in even slower. Makes sense. Not getting the gains as fast, but it's also not depreciating as fast. Or like, you know, less susceptible to price swings. Nice is a good break if it breaks here. Nice resistance. Then this channel. And then VWAP. Do it. I went in heavy here. I should have gone in heavier here and scaled in a smaller amount here, but I think that's the right way to do it. Because this was a confirmation. This was just potential for this little move. Love when people say faster. They have like a fast mode on here. Go do it. I'm gonna try and call my bluff. Or someone have a straight. Patience is winning again on Les Buy. Did a couple little scalps there. Say I overtraded it, but they were successful, so give it as overtrading. I knew my risks. I sized accordingly based on the risk reward. Killed losers quickly. Took profits for non-stop losses quickly. How many straights out here? Two pair. This. Pretty slow price action, not crazy. Make me think it's... Is there the reversal happening yet? It's still early in the day. I'll need to see some pullback. Then a reload. I don't know. It'll melt up. I guess that is the nature of June.
Cutting into some of these valuations, I'd like to know your thoughts.
We're gonna come back from lunch. It's gonna be a VWAP.
Yeah, you know,
they're gonna take the reins.
We've talked
take her to
about,
new highs.
You know, the three of us have talked about many times the fact that a lot of times companies are very expensive for very good reason, because they're very likely to grow into those multiples. We saw it with Amazon. We've seen it with Tesla. We've seen it with NVIDIA. You know, so valuation is not what scares me as much on NVIDIA as what scares me a little bit is that, you know, in, what was it, Q2, they had that big blowout earnings that just absolutely ripped the market apart. The stock went up incredibly. No one had ever seen anything like it. And then their last earnings report, they put out basically the same thing, you know, raising guidance by billions of dollars, beating profit estimates by billions of dollars, and the stock closed flat. So it tells me that Wall Street's expectations have adjusted to, you know, sort of like, if they don't hit a grand slam, it's a disappointing at bat. And so if they come up in this next earnings report and just hit a triple and only raise their outlook by a few $1 billion, you know, what will happen to the stock? Because they've set themselves up where it's impossible to predict what they're going to be able to produce. And Wall Street just kind of expects them to blow everything away again. So that, I think, is the biggest risk for NVIDIA. I think on the other side of the coin, AMD, what we're seeing at Likefolio in terms of that web visits, I think is the best predictor of revenue for AMD. It tells us that, you know, people that can't get the NVIDIA chips, that's where they're going.
What is this thing?
That's a considerable and growing bucket.
Like a throwback.
There's only so much NVIDIA can produce. And I think that's the big limiting factor. It's got nothing to do with demand. It's how much can they produce.
Andy, when you guys look at you know, sectors like this, you know, we're talking chips, we're talking all three of these.
Yes, the dailies are up 47%.
Which is awesome. But do you
the ones
look
for
at other
next,
sectors
yeah,
that
it's
like
Monday. That's why they're going so slow.
In is going to win, and if they continue to innovate the way that NVIDIA does, it's almost like you can't move away from them because they're innovating at a faster pace. They're first to market. Do you see that in other sectors like you're seeing that here with NVIDIA?
Yeah, I think we really saw that with Google. We saw that with Amazon. We saw that. We are seeing that with Tesla. You know, I think that happens more often, I think, than we like to give credit to. A lot of times people think of like the first mover as the pioneer, you know, the pioneer that gets all the arrows in the back. I think, you know, if you do it and you do it really well, like NVIDIA is doing with AI, then it can be a lead that never gets caught. And I think that's a likely scenario for NVIDIA. But I also think that the pie is big enough to have more than one winner as we go forward, just as we will in those other sectors.
Yeah, we've definitely seen demand outpace supply at this point in this space. So it's supposed to last a couple years. Lisa Su said through 2027 for some of these chip makers, the AI boom. So we'll have to wait and see on that. All right, Andy, great stuff as always. Have a great weekend.
You too, appreciate it.
All right, that's Andy Swan, co-founder at Likefolio, breaking down NVIDIA data. Kev, you know, we've been hitting NVIDIA with them for the last probably 6-9 months or so. And just some of the data that they provide is always relatively positive. But Andy made that mention. They knocked it out of the park last earnings, and this stock actually turned around and fell off all-time highs.
Yeah, there's so much human nature in trading, Tom, right? That they blow it out one time, they put up the exact same number, and a complete different reaction to the numbers. So, you know, the market, I've said this before, the market's spoiled, and it gets disappointed very easily, as you know. But yeah, I mean, NVIDIA keeps putting up the numbers, but can they keep up a 113 PE pace and a 35 times sales pace? That's the question. If they do, the stock's going to react incredibly, but there is some competition problems, and there is the problem of potential disappointment that's always out there.
Yeah, Kev, and you mentioned that when we talked about Joe's trade in AMD, you've got something similar here because, you know, it's a relatively short-term trade. So how do you want to look at this one in NVIDIA?
So if you look at the chart in NVIDIA, since its run-up, it's stayed in a fairly good range, but vols are still at pretty good levels. So in an effort to stay ahead of the movement and ahead of the event that's coming up, I went out just 14 days, Tom, and looked at a trade. Remember, this is short durations, playing the range-bound strategy that you see on the chart, but staying risk-defined. I went to the October 27th, only 2 weeks from now, and I went out $30 wide, $35 wide, in 32s, right around there, in each direction, which is about the expected move, Tom. So I did the 500, 505 call vertical. I did the 435, 430 put vertical. So $65 width between the two strikes. I'm collecting about $1.50, which is right at 30 cents per dollar. And this is just, you know, playing the short-term range-bound trade in NVIDIA, preparing for the big trade that's coming up prior to the event, Tom.
Yeah, let's take a look at this one. Similar in that using that same October 27th weekly series that expires in 2 weeks. Selling a call vertical, selling the 500 strike call and buying the 505 strike call. And then on the put side, selling the 435 put, buying the 430 put. Out of the money call vertical, out of the money put vertical, collecting $1.50 credit. Your risk is $350 per spread, and that's below 430 and above 505. So you've got a nice wide range for this one to trade in. The most you can make is the credit that you collect on this one. And if you look at this, the 50-day moving average, it's just above there. Maybe that acts as an area of support around 450. And then those all-time highs that we hit just before or just after earnings last quarter, just above 502. But your break-evens
I was looking for support
one,
back on that.
433.50 on the downside, 501.50 on the upside on there. Kevin, and if you look at the probabilities on this one, you've even got better probabilities than Joe had on his on the upside. That 500 strike, probability 87% it's going to be out of the money. And then on the downside, that short 435 put, about 76%. Is that what you're looking for?
I hate this guy.
Yeah, exactly. All I'm trying to do is make money off of theta, right? It's about $7.50 a day. I'm very
That's awesome.
I'm less than 1 delta,
Glad I
so I'm pretty equidistant
That'd
on
be
either
good.
side. And look at the chart, Tom.
Good entertainment for the kiddos.
It's up near $500.
I guess bad entertainment, but good, wholesome entertainment.
Below 430,
but not entertaining.
Not very much.
That's the best kind of entertainment for your kids. The most boring. Like looking at a rock and being entertained.
Volatility's probably not coming
What
down.
you want.
Like I said, we're safely ahead
Never bored.
Of that event, Tom. Short-term range-bound trades.
Yeah, range-bound, risk-defined. You do have some assignment risk, just like on Joe's
I missed the
iron
hearts.
condor on
You
this
probably
one.
is going to be like
You've got assignment
a
risk
card
on put
shark.
options going into expiration.
Leave
over the
her
next
in
14
front of
days.
that
Also,
happy money
if the
stream
stock
too
moves
long.
away from current levels. So keep
Go to
that
Vegas,
in
come
mind.
back with
But a
like
neutral
3 new
strategy,
Hummers.
Taking advantage of positive time decay or theta on this one, where you want the price of this iron condor to contract into expiration. All right, Kev, we're going to take a quick break here. When we come back, we're going to talk another chip maker.
Wanna
The last
hold
one's
through
gonna
this.
be Intel. It's rallied about 36,
Push
37%
back, but I
so
don't
far this
know.
year. Reports earnings in a couple of weeks. Fast markets.
Have some respect. Barbies is far more important. She can just eat those. Oh, I should definitely raise there. No ice spy. Still haven't gotten quite to VWAP, so. Set up a little head and shoulders here, though. I'm gonna trim some here. Most stuff's pretty slow today. Well, Groupon. The bounce, man. Wow. Not sure my dailies want to wait through all this liquidity building. Still early, 12:45. Which I had to. Alright, I'm gonna close the daily on the small account. Small account's up 32% today. This is the way. Who's calling? 2 pair? Maybe diamonds? Maybe a straight? A lot of ways you could beat me. Yep, he's high. Blush. Raised it more aggressive sooner, I guess. Yeah, these Monday contracts really don't move that much at all. Crazy. Could have gone even bigger. Went pretty heavy on it on this break. Started here and then where was it? Where was it? Here? Yeah, this one. I think. Add to the call. I like VWAP so close. See what I got. VWAP. Dude, these are clubs. A turn.
Because we haven't seen effectively a recycle or a cycle refresh for demand for computers like laptops and, of course, desktops really since the pandemic. And I think we're due for that cycle turnaround.
I'm closing some more of these.
George, you touched on exactly what my question was going to be.
I
8
stomp on the rest.
consecutive quarters of declining PC shipments, down 9% last quarter, year over year. Is a replacement cycle, is a PC crash, and a recovery in PCs. But the question is that enough for Intel? Will that put them back on the map, George? They're making improvements. They're doing all the right things, but they need this business cycle to turn around.
We're still stuck in it.
They do, and I think that's a good point to bring up because, I mean, looking at the chart, I mean,
Potentially
it's very volatile.
just bears building liquidity here.
On a daily basis, but if you strip out some of the volatility of the weekly chart,
if we continue to respect the taper, though, we could honestly still have another upside.
You know, it's tough to
potential.
say whether we're going to get a turnaround, you know, soon. I suggest we're probably going to see some sort of turnaround in 2024. Some analysts see it on the back half of 24. Some see it, you know, coming up in Q2 of 2024. But the price is moving first. So I think that's very telling here because Intel really relies on end markets for computers. But at the same time, I think their movement into the industrial automation markets is also another catalyst for this company. So, you know, the multiple is probably expanding.
Yeah, I got stopped out on those.
Peers moving to the upside. But at the same time,
Stoked.
when you look
Green
at the
Day.
profile of earnings estimates going forward in the next 4 quarters, the
Gotta remember that on Fridays how it's
so I think that's also very
trading
telling,
Mondays.
considering the stock is moving first.
Which makes it just
earnings estimates are catching up, also moving higher. And again,
a
we
lot
may
less,
be witnessing or seeing the
action.
beginnings of a CPU turnaround because of demand for NPCs, and of course the server market, which again is another component of their the CPUs.
Yeah, and we can't forget that they just recently announced that its intent to separate that PSG group operations from the overall company, but definitely lagging. But
could be looking into calls again here,
actually.
actually.
37%. All right, thanks to George Tillis,
Dude,
Senior
man.
Markets correspondent here on the network, breaking
He
chips
gets
all
dealt
day.
the cards.
I mean, when you look at this one, you know, is it justified that it's up 37% so far this year? But if you look at it on a 3-year chart like you like to do, I mean, this stock was trading above $68 about 2.5 years ago.
Yeah, the 3-year chart tells a different story, Tom, than the 1-year chart, doesn't it?
Yeah.
And it says that Intel's gone through some rough periods here along the way. Are they starting to recover? It certainly looks like it. I like what George said about the stock's moving first. The stock may be moving ahead of the actual business moving forward. So, listen, I think they need this business
Royal
cycle
flush
to
coming
turn
in.
to the higher. And you can say that for a lot of chip makers, Tom, frankly.
I guess not.
You say that for Micron. You can say that for a lot of companies. They need this cycle to turn back up and get some replacement. If that does, I don't know if they'll be, you know, the leader, but they'll be in there, that's for sure. You know, AMD and NVIDIA clearly are the leaders right now, but Intel will have its spot in that group, sure.
Yeah, and those PC shipments that dropped 9% in Q3. Gartner came out with a report and said they're expected to grow in Q4. So maybe we have seen the bottom in that cycle, and that'll only help Intel. So, Kev, I looked at this one a little bit different. After that rally, maybe not based on fundamentals, but it's getting dragged along with the other big names. It's not up as much. It's cheaper on a valuation basis. But I
Up
looked
on
at
1
something.
o'clock.
If it pays out their dividend, it's about 1.4%
yeah, you see it just chopping around
dividend
now.
yield. So I looked at a
Bull's
paid-to-wait type
gonna
of
keep
strategy
it going and
here where you can sell an upside call against some long stocks. So I looked at a covered call strategy here, Kev. For every
Just
100
still
shares of
building
stock you
liquidity.
buy, sell one of the Nov 17th, the monthly options, the 39 strike call. You're paying roughly about a $35.35 debit for that. That's where your break even is going to be. So you're buying the shares at a discount on this one, Kev. But they've got you know, earnings coming up on the 26th of this month. That might be a catalyst to the upside or downside, or maybe no movement at all. But you've got about $3,535 in risk on this one. That's if the stock were to go to zero. Keep that in mind. But Kev, when you look at this type of strategy, it's almost like hey, if you do want to own the shares, here's a way to offset some of the costs on it, reduce your break even and your risk a little bit while also creating some yield, right?
Yeah, Intel actually has a dividend yield, so therefore one trade you should look at is probably in the covered call strategy. Now, the only risk that you're fending off is the premium that you collect on that call. But if you do that robotically over a long period of time, your returns are going to be better than normal, right? Because, I mean, hopefully this strategy that we talk about a lot on this show, the reason we talk about it a lot is because one or two things has to happen. You have the same risk on the downside as you do if you just own the stock. But either that call is going to zero or that underlying is going up towards that short strike. So there's a lot of advantages to, in a long-term portfolio, playing the short covered call, Tom, and this puts it on in one trade.
Yep, and you do have some assignment risk where you can get your shares taken away if it's above that strike at expiration. But Kevin, you also get that opportunity to roll or adjust that short call as you get closer to expiration. You got 35 days in that short call and above the current share price. Kev, real quick here, we've only got about 30 seconds. What should investors be focused on for the rest of the day?
Oh, I got to fold out of.
This is a nervous market going into the weekend, Tom. Geopolitics will take over the news cycle as we get through the day. So watch how the market closes. Watch volatility. Watch gold. Watch bonds, Tom. It's going to be an interesting end of the week here.
Yep, definitely watching all those asset classes and keeping an eye on those geopolitical risks. All right, that's going to do it for Kevin and I today here on Fast Market. But stick around right here on the Schwab Network.
Stick around.
It's coming up.
Dude, look at that. SPY found support right there. Might be getting back into calls. Even though we're just still in chop. It's ugly. Wait, no, wait. Now I kind of want to see a bigger break. Firm. Trips. I'm glad I closed out of the daily on my small account up there. I think I'm going to do that. I'm just going to do full account, full port challenge. Still practice risk management with scaling out and cutting losses, but just fully using the whole portfolio for every entry. Well, then I can't scale in though. I guess it's what I was doing before. I was using up all my buying power. More or less the same thing. Call. Folded.
Popularity of the brands and the long-standing nature of them. We used to say with Levi, you know, this company goes back to the Civil War. Well, I think you guys were telling me that Birkenstock predates the U.S. and it goes
1774.
Well, there you go. No one's questioning the
He
company's
puts here, actually.
success, its
Yes.
importance for the people who buy
Wasn't
these
prepared.
products. But the question is, what is it worth? And the market right now is saying it's not worth what the initial public offering was shooting for, which was 46 a share. This thing's way underwater. We're over 20% below that price. So this, based off of that, you know, kind of objective analysis at this point, this is a pretty colossal failure for the banks that were associated with this. What does that do to the IPO market? ARM came in, it spurred this optimism. all these names sort of became public right after that. This is a pretty public disappointment. We'll see if the IPO market cools down now post-Birkenstock.
And yeah, to your point about $46 a share was their initial price. That was actually at the lower end of the midpoint. So that was already kind of disappointing in terms of what we had been expecting. Our next name today, though, is Lululemon. And Lululemon today catching some analyst news. Wells Fargo reiterating Lululemon as overweight. The firm said the retailer continues to buck the overall trend, going on to say that after hosting some of the company's top executives for an investment meeting, that management sees solid momentum in their business with share gains only continuing now across the globe, and that despite a choppy retail backdrop, they still see Lululemon as an outperformer.
What?
They said that Lululemon continues just to be this consistent, reliable brand in the overall retail world. And of the analysts that cover this name, there are 25 buys, 5 holds, 100 perform, and 1 lone sell, which I can remember when that sell came out, and I was extremely personally upset. But shares of this name have fared what has been a difficult storm for retail moderately well. I mean, they're outperforming a name like Nike so well. I think it's difficult to compare the two because Nike has such a reach overseas. Lululemon does not.
Why did you
seems
default?
to have boded well for them this year. But I will say that because Lululemon is probably the apparel retailer at which I shop at the most, they are discounting more than ever. I've never seen sales, and they're still not even great sales, but they're definitely more consistent, more frequent than I've ever seen.
And this is maybe goes without saying. You're personally upset because you like the clothes, not necessarily because you think the stock should be worth something. I don't want it to get misconstrued.
Correct. It's because I own bias just to the clothes.
But it sounds like as a consumer,
up all my buying power too.
And maybe I know it's like that we bought too much of this is typically what they say when they get the discounts or something with more of an inventory management. That's happening more and more often. Sounds like a win for the consumer. Lulu, on the other hand, though, did, of course, sell off dramatically last year as the overall market did and has been doing its best to make that back.
Down here.
Did peak out just over 400 about a month and a half ago. However, it's basically there again now. Like you look at this name, and I know it's pulled back a little bit, but this has been a strong performer basically throughout. Granted, it was closer to 485, 500 in that range. On its all-time high of 485.
It's a smaller position. I was not prepared for it.
$100 off, that's good. 25%, 20% below. All things considered, Lulu has been an outperformer in this space despite being an outperformer for the better part of the last decade.
I completely agree, and I have to think they remain somewhat insulated from some of the overall headwinds that are weighing on consumers because this is an expensive company to shop at. I mean, everyone that has been to a Lululemon knows what I'm talking about. You can't walk out of there for less than $100 for even just one item. It is very pricey, so it's a reason I don't frequent Lululemon.
Would you say, though, because let's compare it to like a luxury brand, we don't need to name one in particular, but you'll be looking at some of these designers, they'll be selling t-shirts for $300. It's not like absurd where you're just like trying to paint that you're spending too much money on something. There's this perception that you're buying quality items, and whether or not they're worth that, I know it's a high margin company, there's still this feeling where it's not like they're just trying to spend a bunch of money and buying these designer things to show it off.
No, there is definitely the perception of brand quality. I mean, I can speak to that. Their thermal gear is amazing. You can run outside in Chicago in the middle of the winter, so that to me speaks for itself. I mean, that is technology that is doing something different in clothing. Our next name today, though, completely different story than Lululemon's resiliency. That is all things Victoria's Secret, which is down 57% here on the year. Now, Telsey did reiterate its market perform rating on shares, $21 price target. UBS actually also earlier this week did say that they see very little catalyst going forward, noting that this retailer's outlook is not expected to drive big changes to their 2023 earnings estimates. UBS said the guidance reiteration over the event, which was basically their investor
I have a higher flush. Very well could. I guess I have the lowest. Dang it. I have the lowest flush.
They continue to have a sell rating on shares as they don't believe they're on the path to establish a clear, differentiated, and relevant brand positioning that will enable
we landed one club.
Growth. I thought that UBS
note was
beautiful. More interesting than Telsey today, just because they basically
one club.
said they don't see any growth
so aggressive.
For this company. I mean, that's
so let's play
good.
translators. This is how I was gonna ask you this. So it sounds like it's right on topic with what the analysts are saying. It's not gonna be us injecting thoughts. Look, first off, I don't think they sell a single item that I would ever be targeted for. So this isn't my wheelhouse. But what I will ask is this another one of these companies that had its heyday in the 90s, the early 2000s, whenever it would have been, and has maybe lost its brand loyalty, brand power, and needs to reinvent itself. Look at all these brands. We talked Gas not that long ago. We've been talking Gap, and we've been talking Abercrombie. We've been talking these names, and to various degrees, at each point, they've tried to become relevant again. Is something like that necessary at Victoria's Secret? Because I look at this chart,
1 o'clock. We really,
and I don't know how you can tell me something good's going on there.
The only good thing that, well, yes, I think they need a reinvention 100%. They are being sold, their products are sold on Amazon now, which could be perhaps a bright spot, but they made the major critical misstep. It was about 10 years ago at this point. They stopped selling swimwear, which was, I mean, frankly, the only reason I ever even knew about the brand. And then a few years later, they were like, oh, we made a mistake, we'll bring back swimwear, but the damage had been done. They lost that loyal consumer when they stopped selling swimwear. I mean, I could put a date on that and just say that has been the demise of the stock ever since.
Close those other January ones I accidentally opened.
Get the swimwear back in the forefront, but I also have to wonder too. This is a business that operated in the heyday of the mall, when that's where a lot of shopping was happening, and sort of this move towards e-commerce didn't just hurt the mall and brick and mortar. It allowed for barriers to entry for kind of small businesses to reach way more markets. You see so many Instagram shops and things like that where you're just clicking buttons. Next thing you know, you're buying something. I can't imagine that helped these legacy retailers that, quite frankly, probably just got a little bit complacent.
I completely agree. If you can recall, they weren't exactly crushing it when they were under the L Brands portfolio. It was Bath & Body Works that was the bright spot. It was never Victoria's Secret. So no surprise that we're seeing shares, I mean, down on the year considerably. Last name today, though, a little bit different sentiment here, as it's actually one of the best performers of the group. That is On Holdings, which is up 37% here on the year. The new shoe player in the overall fitness world. Now, Needham did maintain a buy rating with a $40 price target. We have seen analysts recently update their coverage over the last month, actually last week. Baird was another one upgrading shares with a $33 price target. They did just unveil their 3-year targets last week ahead of their first investor day as a public company, saying that by 2026, they plan to double their revenue to at least $3.9 billion, translating to compound annual growth rate of around 26%, which isn't bad for a relatively new company. Now, beyond 2026, they say they hope to achieve net sales growth of around 20 to 25% annually, with adjusted EBITDA margins reaching more than 20%. So no wonder this name is fairly loved among those that cover it. 17 analysts, 14 have buys, 2 holds, 1 underperformed, but no outright sells.
Completely unintentionally, this is the type of company I'm talking about. Look, I don't want to short sell the accomplishments of this company. I mean, they are a massive, I'm looking at it in real time, $7.5 billion company at this point. They're not some small Instagram shop, but these kind of companies have been able to come to the forefront because of e-commerce, because of the fact that you don't need to go through these big box retailers to get your products in front of consumers. If you make something that is perceived as a strong quality product for a fair, affordable price, and it just happens to look really cool and sleek at the same time, people will buy them. And that's why companies like Hoka, that's why companies like On have really disrupted this footwear space in the way that a Lululemon has tried and somewhat failed, the way that an Under Armour has tried and somewhat failed.
Some more here.
Nike had dominated this space for so long, alongside some of those other key brands, your Brooks, your Asics.
Leaving these runners.
These companies came in and have done what a lot of companies have not been able to do. It's really, really impressive. And so I thought for this next segment, we should look ahead. What are the companies that are pushing things forward right now of these 4? I think it's clearly Lulu and On. The other 2, it's like looking back in the past.
It is. I completely agree, especially Victoria's Secret. But Lululemon, definitely more innovative, pushing into menswear, children's, and of course On is one of the hottest now shoes throughout the market. So we'll be diving more into those 2 upvotes today, looking at some example trades as well as key technicals to keep on your radar. Stick around. Next Gen Investing. We'll be right back.
I haven't broken it yet, but we might. Yeah, if we break low, I mean, we've come down quite a bit. And yeah, today it's still young today. Bears built liquidity for like, I don't know, 11 to 1, like 2 hours. Pretty much this whole area. I think that's what all that was. And we'll just see if they have enough stamina to push it through. Remember when I was saying that too, and this was climbing up? I'm like, this still looks kind of bearish. There's low of day. There's some of this clutter. Did end up getting the flush there. That's too risky. Oh, the bounce. I'm just gonna probably leave these. They'll get stopped out. Maybe do a trailing stop on them.
Lines in price, you know, we made the argument. On one hand, we broke out. On the other hand, we didn't necessarily break out. RSI is a little more clear. It's a little more cut and dry here because we don't have the highs and lows. On the intraday, we just have the closes. And you can see we had this downward sloping trend line. RSI was bearish. We did break above that trend line, though, at a similar time that price broke above its closing price trend line that we drew here. Now, we were looking actually even a little bit better before this segment here because price was moving beyond that 50 midline that separates bearish and bullish momentum here. So what the bulls would really want to see would be a cross above that 50 level that would suggest momentum continuing to improve and shifting more toward the upside there, picking up steam to the upside, but that hasn't happened yet here. Now we're kind of in this no man's land between our two trend lines there. Really what we'd want to see would be for price to lead the way to the upside there.
So now as far as support and resistance goes, what are you keeping on your radar here? We do have some time as Lululemon does historically report at the end of the earnings cycle.
Well, once we add in volume profile here, we can see that where we are on this chart right now is a pretty important area. It's the volume profile point of control, the area of the heaviest trading, commonly used as a source of support or resistance. This is a congestion zone that we're in. And right now, it's not looking like we're going to make it through based on this intraday price activity here. We couldn't even clear any of our moving averages that we're close to right now. So this area near 380 looks even more important than it did initially first based on our moving averages being almost right on top of each other in this zone. 386 to the upside, that's the ultimate mark to beat here. That's the thing we need to really push above here. But to the downside, we can see we've got another node right around the 370 area. The 360 area to the downside represents a double bottom in terms of closing prices. So that's another important floor for price here. If we were to keep falling lower, if things really start to fall apart here, purple 252 EMA just below that 360 mark, and then the old lows right here near 351.
And that begs the question, how much longer can they remain this resilient? I mean, with a nice more than 2.5% move to the upside this week and obviously making a slight move higher today. So with this in mind, Alex, considering this name has done, I would say, okay, because we have names like Urban Outfitters, Abercrombie & Fitch that are crushing it. They're not quite there yet, but they're still, up 28% this year. So walk us through a more neutral to bullish leaning trade.
Yeah, maybe some cause for concern bumping up against that kind of wall of volume overhead that Rick had laid out. So maybe you don't want an outright bullish strategy, but you still like this name. And so you talked a little bit, Jenny, about discounting in Lululemon being a little bit more rampant. Well, we're going to use an options strategy, not to get a deal or anything like that, but lower the break even. So in a way, sort of do some discounting of our own. And so what I looked at was looking at a skewed put butterfly, just going out to the November monthlies. You had mentioned, hey, there's no earnings for a while, so we can go out quite a bit of ways in time. We went up to the November monthlies, $10 wide strike availability, so just a little bit bigger trade than we oftentimes will look at. That's due to the size of the spread between these options that are available. Buying one of the 370s, selling two of the 360s, and then define the risk by skipping a strike, making this a skewed $20 wide credit spread, buying the 340. If we're able to do this for a credit, and let's say that credit is 75 cents, anything which all these options are out of the money, so that's be above 370, an investor or a trader deploying this strategy would simply hope to keep that credit that they received for doing this. In that case, that would be $75 in profit. Where things get interesting, as you can see here, between 370 and 360 and right at 360 it peaks out. Thing can expand to as much as 1,075 in profit. But most importantly, it's this back half. It brings down this break even to 349.25. So 925 in risk, that takes place below that 340 mark. But quite a wide window here, Jenny. 349.25 is the break even. Done for a credit, so no upside risk.
Hey, I'm always a proponent of discounting, whether it comes to options or when it comes to just shopping at Lululemon. But now to shift gears here and look at On Holdings, which shows us, Rick, the power of the aesthetically pleasing shoe, because running shoes are notoriously ugly. They've managed to make these shoes that are very good looking. They've appealed to so many. Like Alex mentioned, they've marketed so well on social media. But as far as the chart goes, is it as strong as momentum does feel behind this brand?
It was looking pretty good before, and earnings really changed the story in this stock multiple times here. Take a look all the way back here at these earnings that we carved out from April earlier this year. Excuse me, March, not April, March. So we had a big move upward here. We retested the level where that gap opened up. You can see that we were right around that 25.50 level. We retested it right there and then continued our move upward, propelling us into new highs near 37. However, quickly after that, we had a big gap downward with earnings. We fell 14% in one day, and that really took the wind out of the sails.
Guys, for support on this Friday.
We never really were quite able to make our way above that 31 level
had a good
again.
week.
Kind of just drifting downward here. Our overall shape
15
was
of you,
a
I appreciate your
falling
thumbs
wedge-type
ups.
shape here. Two trend lines, one
At
going
the low of
across
the day.
highs, starting with those yearly highs, another one going across the lows, converging toward each other. Typically regarded as a more bullish pattern, but really it can go either way. What you're looking for would be a breakout beyond either of those trend lines here. We lost the 25.50 level, that area where we bottomed out twice. Yeah. 2 times there, and then we topped out there once again. Actually, and we bottomed out there one more time too. So this is why I'm always harping on keeping an eye on those gaps and making sure you're aware of these key price levels, because they can be very important here. So overall, moving average is trending down once again. The faster ones are starting to outpace the slower moving averages. The trend is down. We're looking at a downtrend here, and I don't see, once again, really many signs of things changing right at this point.
So as far as RSI goes, momentum behind this trend, what are you seeing?
Well, once again, we've got a longer-term downward sloping trend line in the RSI here that kind of lines up with our price action. It's interesting, though, because you can see that even as price was trending lower here, making lower lows, RSI was mostly remaining stable. We didn't really make significant lows in the RSI. For the most part, except for one day, we stayed above that oversold area as well. We did not go into that area. That would be a sign of weakness if we were to slip below 30 on the RSI here. So momentum is not holding up, or excuse me, it's not looking as bad as it could be. It's holding up a little bit here. But the price action is not good, though. Price is still making new lows. We broke through support. The trend is down. So, I mean, overall, the bigger picture is momentum is down, but it's not as bad as it could be.
Okay, and that's a good takeaway here. Now, as far as some key levels you're keeping on your radar, they do have earnings on November 14th. Again, some time until we hear from their next report.
Yeah, and if we were to once again incorporate our volume profile study here, the 22 level to the downside. I'm more worried about the downside
new low
right now, but we'll talk about both sides.
There it's going, maybe
starting
to flush.
This level all the way back over here where we formed this. This
we've
gap.
got a long way we can come down still.
Because
130.
This is also the site of a small volume node, and you know these gaps, they look to be filled. We see this happen
volume
frequently.
On that drop.
Of course, as always, not a guarantee that's going to happen here. But the 25.50 mark, that's the point that bulls would really want to recapture here. That was where we had that double bottom type floor, actually more of a triple
I was late on those
bottom
puts, but I'm glad
really.
I still got them.
And we weren't quite
I got the
able to
Januaries.
recapture it. 21 EMA, right in line with our downward sloping trend line there.
If this channel holds.
23 level here. So basically 22 and 25.50
By the time I got the Mondays, it was worse entry.
Support and resistance.
Yeah, and it just made me realize this didn't even sound 6% just this week. So
position size was much smaller though than this one. This one had like 30 contracts. This was like 5.
Both of these charts, Rick Ducat, our chart master.
Especially since I was late, and
so now in trading
risk reward didn't look as good to me. But now that we're breaking through the lows, this could end up being
do have an average
large.
price target of $33, so $10 of upside from here.
Yeah, leaning into some of the weakness in this name, maybe hoping for a bit of a bounce back. This strategy would seek to benefit from a bounce back in this name. But say you didn't want to just outright buy stock. It's moving around a bit. You want something a little bit more risk defined, maybe a little bit less capital associated with it. What we're looking at is a call debit spread in this name going out to November 10th. You mentioned November 14th being that earnings event. This would be ahead of that. So no earnings to worry about unless there's some sort of surprise at this point. November 10th, 22.25. So what do we talk about with debit spreads every single time? Well, we talk about one in the money, one out of the money. Buy the one that's slightly in the money, sell the one that's slightly out. Creating a risk profile with equal risk to reward if you can spend half the width of the strike. So $3 wide spread, we spent a $1.50 in debit, creating $150 in risk below 22 and $150 in profit above 25. But that's not all that we seek to find. We try to find a break even, 23.50, that is really close to the current share
sit on my hands
price.
because I only have 4 contracts.
Right now, It's $23.54. So if that $1.50 price is something that could be attained, Jenny,
Look for maybe
this would check both of
reload
those
spot.
sort of loose guidelines that we look at when structuring a debit
Maybe a
spread.
retest
Right,
of
like
that.
you mentioned, obviously not including that earnings premium
Breakdown.
expired before that date. But with that great breakdown on both of these example trades, now we're shifting gears because coming up next, we are finally getting to discuss all things Microsoft as that deal with Activision has officially gone through.
Wars.
$75 billion, one of its largest deals ever.
Probably.
We'll discuss more why shares are
Yeah.
down about 1% today, coming up next.
Yeah, I mean, that engulfing candle yesterday, playing out. Dude, this girl, it's crazy good hands. He knows I'm bluffing. Okay. Not paying enough attention, and I'm just not going to get hands on things. Wow, I'm done. A lot. WSOP.
Watchdog, that was the one that initially blocked the deal. Then about a month ago, they were basically saying it'll go through. So that to me was the biggest news. That was the sign that we were going to get the all clear. Today wasn't fairly that shocking, but we finally do have this over with. So $75 billion is their deal, largest of the company's near 50-year history. It took 21 months to accomplish, like I said, but the deal was completed after it did win that key approval from UK competition authorities. Now, the UK's Competition and Markets Authority did say the deal no longer poses a major threat to competition in cloud gaming. That was just 6 months after they initially rejected the deal. And this shift does come as Microsoft has made some different restructurings to the deal by forfeiting its cloud streaming rights for Call of Duty and other popular Activision franchises in much of the world. So the thought was that when they'd naturally have Xbox would have a monopoly on some of these very popular games, which was then anti-competitive for names like Sony, for example. Now, Activision's cloud streaming rights will instead be sold to Ubisoft Entertainment. The CMA did say this preliminary decision last month. So again, not a huge surprise, but Microsoft said they are very grateful for the CMA's decision. They have now crossed the final regulatory hurdle to closed this deal, and they believe this will benefit players in the industry worldwide. The FTC did say last month it actually plans to start this in-house trial against Microsoft over a different acquisition. So I think that they're just happy to clear this hurdle and finally now move on. I'm happy that we can finally talk about Microsoft as a company that owns Activision versus looking at Activision, to me, for the past several months just felt almost obsolete.
So yeah, if we could get a chart maybe that goes back, it doesn't matter, a year or whatever, but in Activision, what you'll notice if you're looking at this in the summer, mid-July, around, I don't know, middle of July, like I said, 714, 713, in that range, you'll see a massive move higher in Activision, back over $90 a share. That was essentially the signal within the market. There was, of course, news that day that this was going to happen, that this was going to go through. It was a matter of time. When it was within, a couple dollars of that price, that was the signal. Now, it wasn't exactly to the price for a couple reasons.
Love
One,
to slow play that, but I don't get cards to slow play.
And money is not free right now. Interest rate's 5%. So all that time that you're spending sitting in Activision waiting for this to get turned over, you'd be losing out on that risk-free rate. And so that's the idea. That's why there's that discrepancy over time. But you can see, as we've gotten closer to this date, it's worked towards, of course, now being fully off the board altogether. So fascinating story. I think the most exciting piece about this is while it might not be news that this was probably going to be finalized, Jenny, at least it hasn't been the last few months.
Got them on the slow.
Is now these companies can actually start working on this integration. They can actually start getting these two companies formed into one full integrated company in which Microsoft is at the helm of one of the biggest video game developers on the planet.
Yeah, that's, I think, what's the nice step is we can see what these companies look like as one unit, obviously. And the Activision CEO has left the company now after nearly 15 years as the helm. So that is also another leadership shakeup. We'll have to see what Activision looks like under the behemoth that is all things Microsoft. But that's, I think, also important. Shares are down about 1 3/10% today. They're actually coming off their session lows just ever so slightly. But I'm just curious your thoughts. We typically say that the company that's the acquiring party is naturally lower, but we already kind of knew this was going to happen. I mean, why is Microsoft just completely shaking off what is good news?
I would say today, if you look at the overall market, it's basically in line with the market. So I wouldn't credit Microsoft being down 1.3% today to this news. And to be quite frank, I talked about this earlier with Caroline on Morning Trade Live, and Microsoft was up slightly, as was the market. And so when you're looking at this particular story, I think it's more of a longer-term one. As far as the short-term effects, I mean, 21 months ago when this announcement was made, this was a big, big news story, and there was that repricing element. You saw Activision shoot up. You saw a little bit of a move lower in Microsoft, but we're 21 months into this thing. As far as the dollars and cents go, the price was understood. Timetable was a bit uncertain, but we've ultimately been working towards this point for the better part of 2 years.
Right, and obviously I think the story that's more important to Microsoft is anytime they mention AI, it seems to definitely excite investors a little bit more than perhaps this acquisition. But it's always amazing to me with a company as large as Microsoft that they even own Xbox. I feel like that's sort of forgotten about. At least I oftentimes forget about it. Shares are up 37% this year, though. They have pulled back about 6% this week. We're down about 36.5% from highs. They're performing just a lot like the rest of the tech names. Alphabet looks a lot like Microsoft as of late. So we have seen this name, they're actually now unchanged for the week. I'm looking at the wrong numbers, but nonetheless, up 54% from their lows. When trading Microsoft, they don't have earnings until October 24th, which is actually coming up rather quickly. So we do have that catalyst. They're sort of at the tail end of some of these major tech names. Trading Microsoft, the one thing I will say is it's more steady. It's more of a stable name in some of the overall volatility we've seen in tech.
Yeah, especially given the fact that it's been a really, really strong performer for a long, long time, especially if you go back to 2020, 2021. This is one of the ones leading the charge higher. It made a new all-time high on some of the AI hype, so that's, of course, something that's pretty important to look at. But you mentioned the earnings date being kind of in an awkward amount of time away. You could look to next week to avoid it. You could look to establish something for earnings now. Or you could kind of just disregard it, knowing that it's a risk you're going to have to deal with, but that's sort of the nature of the game. Microsoft's a fairly liquid stock. It's probably one that many investors are kind of constantly involved in. and it has made both a pullback off its highs and a recent move higher off of its most recent lows. It's sort of bouncing around on this kind of recent downtrend. And so I looked at something, Jenny, that leans into kind of that story that you were telling, which is this is more of a steady performer typically. It isn't as volatile as, let's say, an NVIDIA or even the names that we were talking about in the last segment in Lulu, or of course a name like ON that's a little bit newer to publicly traded markets. So I looked at selling an iron condor going out to November. So this is going to capture the earnings event, sort of in some ways maybe a necessary evil if you want to go out that far in time. But of course, the option prices are going to reflect that has that event uncertainty within it. So what I looked at was selling the 300, 350 strangle, and then buying $5 wide wings. This creates a $50 wide window, which over the next month or so, which Microsoft just chops around within that window, this thing could be at max profit. Now at the time, it was trading for about $1.70 credit. So that max profit's $170 on $330 in risk, about a 2-to-1 risk to reward ratio, which is sort of loosely within our guidelines. The break evens would be $298.30. You take that $1.70 away from 300, and then you simply add it to the 350, you get $351.70. So a little bit greater than $50, about $53.40 worth of basically you stay between that at expiration. You can be profitable to some extent. $50 wide window where it can be at max profit at expiration. But these are the kind of strategies to me that made options interesting, because we know you can buy a stock if you like it. We know you can sell a stock if you aren't as confident in it anymore. You can sell short if you want to bet against something, buy it back when you feel it's gone down far enough. But options allow you to create neutral strategies, sometimes ones that go for big moves in either direction, and sometimes like this, which is basically saying, I want to see calm. I want to see a range-bound Microsoft that bounces around between 300 and 350 and ultimately ends up in that range.
And it has been fairly range-bound. I mean, I know it's made some moves to the downside, but I feel like it's been 37% up to the upside all year long. It's pretty much been stuck, even though it teeters lower. Seems like shares then uptick, and there's a reason that of the 55 analysts covering this name, 49 have buys. There are no outright sells. So Street does very much like Microsoft, and there's a good reason. But finally closing this chapter of the regulatory hurdle that was all things the Activision acquisition. Now we'll leave it there for FOMO. Now coming up next, it's time to talk these snacking companies that you see very regularly at the grocery store that have not been catching some love as of late. Seeing more analyst downgrades today in the space, more selling pressure. Renita Young will have more on that story for us coming up next.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end
There's your bounce. I moved my stop, so I had some profits and I stopped out. Wow, look at that. Look at that. That's what you call a bottom. I missed it. I had to step away. Breaking on this channel though, you could have grabbed it, especially with all that volume. See if we get a pullback.
it's across the packaged food and beverage investable universe. He believes that they're actually one of the best operators there. This stock also down year to date around 17%. And then lastly, we're taking a look at pardon me, Hormel Foods, which those shares are actually falling today, and its union workers have actually voted to approve a new contract. And so it includes generating more than $250 million in operating income growth by the end of the fiscal year 2026. That is actually plans that the company laid out when it gave its forecast today as well. But two separate things going on, the approval of a contract and then the company giving its forecast for income growth through the end of fiscal year 2026.
I know Jenny's got a thought, but I got to share this.
Okay.
So I know Jenny's loves the Lulus of the world and these fun stores. I'm Hershey's and candy. Now we're talking my kind of thing. I saw that B-roll. I'm excited. I'm going to the vending machine right after this show.
Okay.
That's so funny because I was thinking I'm more Team Campbell's. I love those like condensed soups that are getting very pricey. Perhaps why these companies are seeing some selling. I mean, you spoke to some of the underperformance this year. Hershey's down 17.5%. Campbell's soup down 30%. If you brought in the scope, I mean, Hormel was the worst performer in the S&P 500 yesterday. It's down 31%. Pepsi, Conagra, Coca-Cola, Kraft Heinz. I mean, they are just all absolutely getting crushed. So is this right now just the discontent for some of these rising prices? Is this a consumer staples story? Or is this story that Walmart's CEO cursed him because he said that Ozempic is impacting the way that consumers are shopping? I don't believe it. I refuse to buy that narrative. But hey, we've seen selling ever since that statement, which I know you covered on the show. So what is going on in this space, Renita?
I mean, consumer staples are down around 11% year to date anyway, when we look at one of those indexes tracking it. And also it's been trading pretty close to its lows as well in some areas too. And so we've been hearing a lot just about the consumer not being able to spend as much. Obviously, we know that student loan payments start back this month, and a lot of people have to devote their discretionary income toward that as well. But listen, this is where we find out about which staples are really staples, if they can be substituted, right, and fall to the trade down effect, which are elastic, if the consumer is more elastic or not, and where we find out really just what's the difference between truly discretionary versus staple.
Yeah, I do wonder this too, how correlated some of these names are just simply to the bond market. We had such low rates for so long. These sort of somewhat seen as more defensive, stable performers in the consumer staples world were seen as a place to get some of that income investment, maybe through dividend yield if you felt that that was going to be something they were going to continue to pay. Well, I'm looking at some of these in particular. I mean, the yields are nowhere near where the U.S. Treasuries or, you know, the risk-free rate is right now. That same incentive is just not there for investors.
It's not, and you're very, very spot on when you point that out, because even anecdotally, even when it comes to the fundamentals, we've seen just a shift in how the traditional staples, the traditional staple stocks are being treated right now. So, I mean, it's something to watch for sure.
Right, I mean, no resiliency at all. I feel like this historically is the bright spot when the going gets rough in the overall market. That has not been the case. And I'm like, are people just not eating? I don't understand, because what do you even, I think you made a really good point about trading down, but what do you trade down from Campbell's soup? I mean, to me, that's pretty much bottom of the barrel. It's like 99 cents a can.
Generic type of soup. Store brand, great value, the store brands, you know, there's always something less.
There is always something less. That's a very good point. But great breakdown on all things staples that are fortunately lower today, but perhaps could get some relief on this earnings season. Renita Young, senior markets correspondent for the network. Now, coming up next, it's time for Under 30. We are looking at Mr. Car Wash. Shares are up around 7% on the session. George Stills will have more on that move to the upside coming up next.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Might grab some calls in the break of this channel. See, it very well could close down here, but nice little inverse head and shoulders. Got view up above us too.
the S&P and NASDAQ. That's worth noting. The S&P right now 43.26, down 0.5%, and the NASDAQ is down 1.2% at 14,990. Meantime, the Dow Jones Industrial Average is moving to the upside to the tune of about 27 points right now at 33,658, and the Russell right now is down about 1%. Taking a look at the futures products, we talked about oil moving higher, and this is about sanctions and Russia, and that got a pop today. It's up over $4 at 87.32. Gold, the safe haven of gold, is up about $60 today, 19.41 a troy ounce. And of course, the U.S. dollar 106.47, and Bitcoin up 0.25%. For some of the biggest stories in the markets, Caroline Woods is with us, senior markets correspondent of Schwab Network. And of course, every Friday we've been sitting here talking about the UAW and the expanding strike. And what's the very latest now?
Hey there, Nicole. Yes, keeping an eye on Ford, GM, and Stellantis today, all three under pressure. I will say only Ford and GM lower on the week, though. Stellantis actually ending the week in the green, despite the fact that the strikes, you know, there's no new strikes to speak of, but they continue. We haven't seen any real progress on that front. UAW President Sean Fain did say that the union is sparing GM and Stellantis from further strikes, but did say a lot more strikes could be on the horizon if the big three fail to meet the demand. This, of course, This, of course, comes just 2 days after we saw that strike at the Ford Kentucky truck plant that really hit at the heart of profits. 16% of Ford's revenue is generated there. They make things like Super Duty pickup trucks, but also Ford Expedition, the Lincoln Navigator. So that really, took a toll on Ford, or it could take a toll on Ford. They said a prolonged strike could likely cause stoppages and layoffs at up to 13 other Ford plants that are linked to that one. Now, Fain said that strike sent a clear message to the big three. He said, namely, don't you dare sleepwalk us or lowball us, and that the union is still bargaining hard with GM and Stellantis, but saying with the threat of a strike, we can get them moving. We changed the rules, and now there's only one rule: pony up. So those are some fighting words. He definitely doesn't mince his words. I will say, meanwhile, the New York Times is reporting that Ford says it won't raise its contract offer to the UAW because it will hurt business and its ability to invest in EVs. On a call with reporters, the president of Ford's division that makes combustible engines said combustion engines said, we are very clear, we are at the limit, and more will stretch our ability to invest in the business. So, their initial offer was for 23 to 26% wage gains. UAW just saying that's not enough. So Ford under pressure today, off about 1%. GM's actually down 2%. Stellantis only off modestly, down about 0.4%. But as I said, Stellantis actually higher on the week. Also, you take a look, Tesla also under pressure today, down 3%, not striking. So we are just seeing some overall weakness in the space.
And that's ahead of earnings next week for Tesla.
Right.
Too. And to your point, I saw at least one report that said the 23% raise, that is for the UAW, is the most that they can offer without hurting the company. And I saw a Bloomberg report that said that. So we'll have to wait and see. So it's really almost a month. In the meantime, Netflix in the news, a downgrade before next week's earnings for Netflix. What are you watching there?
Yes, so Netflix reports next Wednesday, and ahead of that, Wolfe Research is actually downgrading the stock to peer perform from outperform without a price target. The analyst at Wolfe says that 2024 average revenue per user expectations look full, and today's paid sharing net additions will lead to tomorrow's gross ads shortfall. The firm said Netflix's valuation is actually reasonable. The stock's up about 20% year to date at this point, but will not withstand falling growth. So I always like to look at how these new calls kind of compare against the rest of Wall Street. About 56% of analysts at this point are still in the buy camp for Netflix.
All right, Psyche,
the
thanks for stopping by, man.
Target is
Happy Friday to you.
So the Netflix is currently trading around
good, buddy. Thanks for all the support this week.
Today. So
Have
analysts
weekend.
on the whole see quite a bit of upside
Jay.
for Netflix still, but Wolfe Research
Who's
didn't
in
give
media?
a price target, but definitely more, sitting on the sidelines, more in the cautious camp. There's also this story out, I don't know if you saw it, that Netflix is actually planning to open essentially
Hedge funds
retail
will now be forced
locations
to
where you
reveal
can
names of the
immerse
stocks that they're
yourself
shorting.
in your favorite shows, whether
Read
it be
about that.
shopping for clothing or even eating themed food from some of the Netflix shows. So those are expected to open in 2025. We don't have a lot of details about where they'll actually be, but this would be Netflix's first real permanent
Got some calls there.
locations. You know, they gave up
I was
the
in them,
DVD
I
business
closed them.
finally. That
Waited
was
for that break,
used
so I
to
got
be the
back in 'em.
physical part of Netflix. So yeah,
I mean, and people like experiences, and I mean, I thought it was fun going to Blockbuster to pick a video, right? You would go
Those
and
were
you
the
would sit there
days.
and you would read, and you
Those were
felt
the
like you
days.
were totally involved in that. And now people love these shows so much. If they have any sort of experience, this Netflix house locations, that sounds like a lot of fun.
Yeah.
That might be something people like to do because it's probably not too expensive.
It's
for
I would
Topics
guess
there.
it's like a theme park kind of thing, but hopefully not with the Disney prices.
Right, exactly. Caroline Woods, thank you.
Sure.
Always. Now let's take a look at the bigger picture. David Wright is with us, President Wright Financial Group, to take a look. I mean, we saw the consumer sentiment number coming in. A little bit of wariness when it comes to the consumer, but they've been quite resilient with the spending. Your thoughts on what you think the pulse of the consumer really is?
Well, this is Friday the 13th, so Nicole, we had a lot of reports this week, right? The PPI on Wednesday,
Whoa.
the CPI yesterday, and
Jumpy.
then the University of Michigan
Jumpy,
Consumer
jumpy.
Sentiment Index. So, you know, you've got one thing that's a lagging indicator, the CPI. That came in a little bit hotter than expected. PPI also came in a little bit hotter than expected. The reality that I'm seeing here is that, you know, consumers are still spending some money, but we see consumer credit card debt increasing at an ever-increasing pace. And right now I'm concerned that the American consumer, the middle American, is going to get bogged down in debt. They are resilient, but I think there's future problems ahead.
And so with the future problems, what kind of problems do you foresee as possibilities?
Well, obviously, I think just by talking to my clients and the children of my clients, a lot of what I'm hearing is that there's expectations that at some point we're going to return to the good old days. Remember 2008, 2009, when we had, you know, 0% interest rates and mortgages that were 3 and 4%. I don't think that's ever going to happen again, at least in my lifetime. So I think there's some expectations that maybe a little out of kilter here.
I broke the channel, but
I see that, you know, when you look at CPI, a lot of the rise in CPI was due to shelter costs. You saw a lot of rise in gasoline. Gasoline was up 8.5% year over year. Food costs, you know, grocery store 3.7%. Eating away from home at restaurants up 7 to 8%. There's Americans that are borrowing on credit cards to pay their bills. So eventually this trickle-down effect of these increased interest rates and stresses on consumers and banks, I think is going to bode not well for the economy in 2024.
So at this point now, I know you have a new book. You're really trying to navigate for retirement for folks. In fact, this book coming out on December 12th, Bonfire of the Sanities. What can readers expect, and why was now the time to put this book out?
Well, Nicole, I'm glad you asked that question. Bonfire of the Sanities is a labor of love. It's a book that talks a lot about everyday consumers, the fact that if you go back in history and look at what the stock market has performed at, there's two basic times when you accumulate money: the accumulation phase, the distribution phase. And if you're in your 30s, 40s, and 50s, you're building wealth, you're not too concerned about what's going on now because you're putting money away for yourself. So this book is structured in such a way, it takes you chapter by chapter into the accumulation years when you can be a little more offense, a little bit more growth oriented in things, take some flyers, know that over time, the market will perform. You and I both know that. But understanding that once you hit your 60s, it's more about the distribution phase and understanding about having money work for you as you take funds from your accounts, and how that whole process and thinking of how you invest needs to change in the latter stages of your work career.
So we're hearing a lot of people going to cash right now. Is that not a good idea?
No, I think that's a great idea, especially when you've got, treasuries paying what they're paying right now. We have a lot of people going to cash. We have a lot of people that are, they're basically saying, we don't need the money right now. We can, tie up the money for maybe 12 months, 24 months, and they're investing in things that can give them, 5 to 6%, basically guaranteed rates that they're taking advantage of that. But we also have some clients that have, they've been blessed. They have a little bit extra funds. That dry powder is sitting on the sideline waiting for opportunities for the feds to make their move. Because, Nicole, I don't know whether you're going to ask me this question or not. It's Friday the 13th. I personally don't think the feds are going to do much moving this year. I think they're going to hold, in the next two meetings. I don't see any hike. I see a pause, and I see probably a pivot mid next year. They're going to need to, just based on a lot of the stresses with the UAW strike and with, just consumer debt and all that.
When you look at the long end and your thoughts on the yield curve, thoughts there?
Yeah, the yield curve is still maintained, although, we saw the 10-year rise this past couple of 3 weeks. The 10-year yield has risen, but a lot of that rising has been due to the fact that, the feds are tightening still. $95 billion is coming off the rolls of Treasury debt that was taken out during COVID in the past several years. So as you well know, as Treasuries go off the books, yields will rise. So the 10-year is in the 4.6 to 4.7 range. However, I'll make a bold statement here. Ready? The bold statement is, I believe that by mid next year, it's very possible that the 10-year yield could be down to 3.5 to 3.75%. Just an opinion. I believe that the bond market is always a little smarter than the stock market, and that the bond market will eventually play itself out.
Interesting, because now, a lot of folks are saying it's more normalized at the current level. So that is a bold statement. Right. David Wright, congratulations on your new book. Thanks for being on with us this Friday. We appreciate it. David Wright, Wright Financial Group. Coming up next, well, our next guest doesn't think that we're in a bull market, but he's got his eyes on defense and energy stocks right now. So find out why. It's all coming up on Schwab Network. We'll be right back.
I remember when I first started flying, and we would
2026. Shares of Hormel are down more than 30% this year. Dollar General is one of the top performers in the S&P 500 today, after announcing plans to bring back its former CEO. Todd Bastos will take over immediately, less than a year after stepping down with plans to retire. Gordon Haskett upgrading the Dollar General to buy from hold on this news. HSBC upgrading the discount retailer to hold from reduce. Insurance company Progressive hitting new all-time highs after its earnings topped expectations. The company reported earnings of $1.89 a share in the latest quarter, up from 20 cents a share a year earlier. It also saw a nearly 20% increase in net premiums. Campbell's Soup rebounding after falling to a 52-week low yesterday. Today's gains come after Stevens initiating coverage with an overweight rating of Campbell's and a price target of $50. That's more than 30% upside from Thursday's closing price. Shares of Campbell, though, are down 31% this year. And a quick peek here at Bitcoin as the Dow is in the green right now. Bitcoin 26,820, up 0.25%. All right, for more on what we're seeing in the markets right now, Lorenzo Esparza is with us, CEO, Manhattan West. Thank you for being with us. So we got those Fed minutes. We've got inflation prints, CPI and PPI. You even got the expectations and the consumer sentiment for more inflation to come than was previously expected. What do you think is happening here, and what do you think the Fed may do?
Great to see you again, by the way. Listen, I think there's a confluence of factors that are influencing what the Fed might do. I'd say, first of all, is obviously the conflict in Israel. I think that's why the market's trading up, because traders are starting to consider the fact that if the markets get, or if we have a geopolitical mess in the Middle East, and that would certainly, give the Fed pause to continue raising right now. So I think at this moment, they're going to be on pause. I said earlier this year that they were done. I think they are done for the year. I actually think we're going to be in a moment of pause of rates for at least, through the early part of next year. And again, it's too early to tell what's happening in the Middle East to have any longer term, point of view about where rates might go.
What do you say to the folks who are concerned about a potential recession? Because there was a lot of talk about a soft landing, and then hard landing and recession started to resurface in some of the chats over the last week or so. Where do you think we stand on that?
This could be the first time the Fed actually, achieves its goal of a soft landing. I think, the consumers are still relatively strong, despite the fact that, mortgage rates have moved up fairly significantly. You're hearing about mortgages in the 7 to 9% range, which, is pretty impactful. But no, look, I think consumers are still spending. I think you see that. And as we've seen, unemployment remains at, 3.7%. So you've got a fairly low unemployment rate. If unemployment stays that low, then, spending and the economy should continue to stay fairly firm.
So as you talk about the cost of capital, we were looking at some of the numbers out of the banks, for example, and some of the loans fell, revenue home loans fell, auto loans fell. We talk about a credit crunch, and that can really freeze up the economy if money's not lending and it's not moving. I mean, while there was some great news on the IPO market loosening up, there's still other parts that seem to be in a little bit of a credit crunch.
Yeah, the one good thing that drove earnings, right? The big banks actually are up today, and they've actually reported strong earnings, and that's because the net interest margin was up, right? So even though it's a slower environment for mortgages and car loans and credit cards, what have you, the banks are making money. The net interest margin, the spread between what they pay and what they make has gone up, and so I think that's a positive sign. But no, I think we're in a unique moment where there's a lot of conflicting forces that are driving activity. But we'll see we'll see what happens in the next 4 weeks. I think there's obviously influence happening with the House of Representatives until we get a speaker named. There's a lot of areas that are causing concern for traders and for investors alike.
This has been so choppy through this level.
When you think about the different areas and opportunities.
Planning on being done for the day, and then
some certain
I overtraded through here.
And even
Give back some profits.
are something you like as well. Tell us some of those things and what might be working.
Stupid when that happens.
Yeah, well,
it wasn't a great setup.
I
just want to gamble, I guess.
We're looking at what's happening in the geopolitical.
But I'm back in. I'm still in calls now. I'm just.
And I think that's going to be an important, component to be invested in over the short period of time, and we'll see a lot.
Getting in and out of positions, how much it just
also
costs.
Energy, right? So what folks are getting worried about domestically is the idea that, oh gosh, oil prices are going way up, and gas prices certainly have. But I think this moment is different in terms of the conflict in the Middle East. We are a net exporter. Right, so we are fairly energy independent. So therefore, I don't think we'll have the kind of shocks that we experienced in the past. So, still like the defense companies, still like energy, and the financials. I think as we've seen a moderating of deposit flight. The banks are giving you good opportunities as well. So those are areas of the equity markets that we like. As your earlier guest said, it's hard to argue with getting 5% in treasuries and cash-like instruments. So I think a good portfolio has proper allocation to the sectors of the equity markets that we think are poised for growth, and having a good allocation to fixed income, very short on the curve with treasuries, and then alternatives. Real estate is probably not where commercial real estate is probably not what I'm looking at the moment. I think that problem gets worse before we're terribly attractive to it. But private credit is an area that is going to help because rates have gone up. And then we like venture capital. I think in 21 the market was hot, in 22 it was cold. We're starting to see some more activity in that space, and kind of the revaluation and the down rounds that companies have taken are lending themselves up. Letting themselves be an opportunity for investment. So those are areas that we think are interesting for investors.
Yeah, and the ones to stay away from. So thank you for those extras. What about M2? When you think about the money supply, what's the important? Because we always think that fiscal policy and monetary policy are supposed to work together, but we do still see a lot of spending when it comes to fiscal policy at this moment, tightening for monetary policy. What about the money supply stands out to you?
Well, I mean, as you may recall, coming into the 2020 COVID crisis, money supply was fairly slow. The Fed increased tremendously. We think that's the primary culprit of what drove inflation. The Fed had said, "Oh, it's transitory. Don't worry about it. It's going to pass," and clearly they were wrong. I think what has happened is you had just a flood of capital and flood of free money going to the market, and that's what caused that inflation. And then you add in the supply chain disruption that took a long time to ease. I think those are the two things that really disrupted, really drove inflation. But what's happening now is money supply is now slowed down, and you can see that with a variety of different factors. There's less capital available. Banks are tightening. I think consumers are having to pay more. So inflation clearly is on the decline. And the impact that the Fed wanted to have with their increased money supply certainly did what it was supposed to do.
Yeah. When we look at investing in fixed income, I mean, that's obviously been a path that people like, particularly on the shorter end, seems to really be working to get a lot of payout for that as rates have moved higher. On the long end, there's really this sense of frustration that those rates really should be higher than the current levels. What do you tell folks who want to buy 30-year bonds and such?
I think that's a dangerous proposition at this moment. I think what was said earlier is look, the bond market typically tells you more things than the equity markets do, and tends to kind of react and provide more clues about where the economy is going. But just as investors flood equities when when the market is hot, they'll flood into bonds when that seems like the asset class. So we would be cautious about going too far out on the yield curve right now. I just don't think it pays to do so. So our concern is that there's going to be a pause, and then next year we think and hope that there's going to be a rate decline, that the Fed will start to chip away at the increases that they've done. I agree that we're probably not coming back to that really low interest rate environment that we enjoyed for so long, but we do think that it'll moderate, and you'll get short rates back down to 4%, hopefully 3.5% in the next year or so. I'd say in the next 12 months.
All right, Lorenzo, thank you so much. Lorenzo Esparza, Manhattan West.
Thank you. Great to see you.
Coming up, ExxonMobil made one of the biggest acquisitions in 2 decades with this Pioneer Natural Resources deal. Does the future hold some good things? What's ahead here? Right now, Exxon is up about 3% and a winner week to date.
Coming down a little bit. It's been such a good Friday. AMC's down 14%. See if SPY can make it happen here. It's 230. They moved to VWAP for safety. And out the week. This chop will get you though. Big candles. Both ways.
Now, Exxon gets a great deal for less than 6 times, probably 5 times earnings or EBITDA, which is kind of about where they're trading. So I think that is a slam dunk deal for Exxon, an okay deal for Pioneer. Over the long term, this will be so synergistic for ExxonMobil. If you're a long-term holder of Pioneer, you're going to be happy. But in the short term, it's kind of a yawner.
I had one guest come on and say that Devon may be a good takeover target going forward based on its valuation. So we'll see. I mean, you could give me your thoughts on that, but I also just wanted to know earnings season and, you know, what you're expecting there.
Yeah, earnings season is really interesting, right? And I'm thinking about it from the Fed's point of view, or at least trying to be. That's a little presumptuous, I guess. But the Fed is watching all these good points and bad points. And one of the things that they're watching is the stock market, right? And earnings. Earnings drive the stock market. And our earnings have been hanging in there all year. They're down some, but they've been hanging in here pretty strong in spite of increased borrowing costs. Now, it's affecting some more than the others. You look at the Russell 2K, that's still down, close to 30% over the last 2 years. These smaller companies are more leveraged, and they're having a tougher time. But if S&P earnings kind of hang in there, and then the S&P leads the market and kind of hangs in there, then I think you'll see that as a positive sign for the Fed, especially given the way the unemployment's been hanging in there. CPI is slowly kind of coming down. You may see another rate hike or two, but not much. They're in the fine-tuning stage here, so they're trying to get it right. But I think they may have another hike in there, and earnings is going to be a big part of it.
Anything keeping you up at night? I mean, you have a labor market that is still very
Wow,
strong,
about
very
19%.
tight labor market.
Huge bounce.
There are some concerns about rising inflation. But is there anything that, I mean, of course, we have a huge deficit when you think about the debt of our country. Tell me a little bit about your thoughts or anything that might be keeping you up at night.
Yeah, a lot of things can splinter and fall apart, right? We know the deficit and Congress is out of control and they're absolutely reckless, and it's unforgivable. Having said that, that puts the Fed in a tight spot, and they're dealing with known variables. Unknown variables show up like the Gaza Strip, and that gets out of control. Now we got a problem, right? Because the greed and fear start to come into play, and then they can ruin things in a hurry. Banks are hanging in there really strong on the credit. I expect that to kind of bloom, to kind of come off the rose a little bit, probably more next year than this year. But I don't expect it to get real bad unless some unknown factor, call it Gaza Strip, gets out of control or something like that. other than that, I think the Fed's doing a really good job given the hand that they've been played and that they started out behind the 8 ball thinking that there really wasn't inflation when there was.
Oh, Jay Powell saying, say it again, Dory. Look, there's a lot of people who criticize the Fed for too much, too late, and all that. But
well, let me address that.
Had a very difficult time. Okay, just quickly,
if you don't mind,
Dory, yes.
Yeah, addressing that just real quick. I think people forget what a killer inflation is. I mean, on paper, and you brought it up earlier, our government's out of control and really broke. 31, 32 trillion in debt, right? We have
Dude, look at this market right now. This is crazy.
So, the minute confidence gets shot, we're done, right? Well, confidence is still there, and right now we're the world's tallest midget, okay? Or as somebody said, the prettiest horse at the glue factory. But having said that, the Fed's dealt this hand, and they know that inflation is the killer, and they have to attack that. And if that means at the expense of you getting a loan or your business
never entered
going
in
down
this.
or having trouble, that's the way it is. You have to be able to manage your business, particularly banks, right? No matter where rates go. So when I have banks complain about where rates are, I go, hey, you don't know your job. Your job is not to bet on rates, but to manage asset liability rise so that you make a margin and a spread no matter where rates go. And people have that same responsibility in their own business.
All right. You always have the greatest sayings, too. Dory Wiley, wonderful to see you. Thank you. Commerce Street Capital. Thanks, Dory Wiley. Good to see you. Still ahead, we'll dive into the impact of cyber attacks, the evolving role of corporate cybersecurity in light of some of the breaches that we've seen recently, MGM, Clorox, just to name a few. Right now, the S&P is down about 23 points. Here's a look at some winners and losers.
Still an hour and a half. Yeah.
The 200-day moving average. And so while we've seen some intraday volatility, again, as investors gear up for another round of earnings and have a lot to focus on in terms of what's playing out as far as the Middle East, Washington, and eco data here in the U.S. in terms of the influence that has on the Fed, again, just sort of in a bit of a holding pattern, kind of this wide range holding pattern. Intraday opportunity has been, a fair amount of. There's been a lot of a wide range intraday swings, but just not a lot of follow through one way or the other on the big picture. So keeping an eye on a big pop in the VIX, I think a reflection of how investors are a little bit uneasy headed into the weekend.
Yeah, a lot going on in crude. Today we saw a big jump in crude. There's a lot of talk about Russia and sanctions and all that. What is the move today attributed to, in your opinion, and what about the week that was?
Well, I think there's a couple things. I mean, we keep hearing about this ground invasion into Gaza, which is imminent. That seems to be kind of giving crude a little bit of a lift. Also concerns that it could become a bit more broader in terms of involvement if that becomes the case. And just the longer this draws out, the more volatile situation it becomes. So again, a little bit of uncertainty heading into the weekend. But then you also have U.S. tightening sanctions on Russia, sanctions on 2 Russian shipping companies, apparently, which violated the G7 price cap. So that's going to spark some of that uncertainty and that unease as you head into the weekend. And in the stocks, oftentimes you see that create a bit of selling unease, but in crude oil and some of the commodities, oftentimes that brings in a bit of a bid. Now, I just wanted to point to, again, in terms of price activity, as far as crude hanging out right around 85, 86. If you look at where we were recently, up around 95, back down to 81, again, it kind of makes sense.
That means it's going to keep dumping or what?
Talking about in terms of the S&P is right in the middle of that range. And the IEA this week talking about how the market remains adequately supplied amidst all of this. So I think price a pretty good reflection of that.
Understood. All right. Thank you for all of that. Really appreciate it. Ben Lichtenstein.
Candles are crazy though.
Let's turn our attention over to cybersecurity. Joining me right now, Nasser Chandra's with us, CEO of Paymerang, here to talk about financial fraud. Thank you so much for being with us. Obviously, there's a lot of costs involved. It is a fearful, scary thing, the big picture of it. But you recently had some breaches and attacks on names like Clorox and MGM. What is it that your message is today?
My message is that cyber security events, ransomware events, and financial fraud can be prevented, I think, if companies are vigilant. And it takes a few simple steps to really reduce your attack surface, to reduce your risk. So what we recommend to clients that are, cutting checks in-house or doing wire transfers and ACH transactions, or have large, sets of users on their networks, is just to be careful with how they're using those networks. And I can talk about each of those separately.
Yeah, I know. I do want to hear that. I mean, when you think about some of the largest breaches, right? I see Yahoo, Microsoft. I mean, we remember a lot of them. First American Financial, Facebook, just to name a few. And some of these are billions of customer user info. LinkedIn would be another. What would be some of the parameters that could be taken? You mentioned a few different ideas.
Yeah, so for cybersecurity, obviously, reducing your attack surface is one. Making sure you're educating your users on how to interact with emails. Right. Email is usually the way in the door. And so when you think of opening an email, you should think of opening your front door. And as you interact with the email, make sure your teams who are interacting with emails know who the email is coming from, what the purpose of the email is, and be very careful about clicking on links that are in the emails, because there could be malware, there could be ransomware.
Right.
Now, a lot of companies also have network intrusion protection and firewalls and things
15
like
minutes
that
to
that
close.
will prevent those
Puts
attacks.
might be the play in today.
There's also a thing called
Might be
application
retesting that
whitelisting.
low.
It's a solution that you can have that will tell your
Pretty
network
bearish in next
these are the
week.
types of applications that can run on the network, and these are the ones that can't. And the ones that can't will be prevented even if someone clicks on that link. So have all of the preventions in place, but also train your teams about social engineering and to be very careful with their emails.
You said even governments have security breaches, right? We think our info is so safe there, but not necessarily, right?
No, governments have had a lot of attacks, and they unfortunately end up in the news. These are local governments, these are federal government agencies as well that have had attacks. And what happens is you're only as strong as the weakest link in the chain. And so you may have a strong network, you may have good firewalls and protections, but if some of your users are, for example, not trained and are clicking on links, or if you have one device somewhere that hasn't had an upgrade to its operating system, hasn't upgraded to security, that is the weakest link, and people will find that weakest link.
Right. You talked about like hotspots where we see malware emails.
People getting paid for barbecue? What does that mean?
You get random texts. You could look for typos or things that you don't recognize. You just don't click
I don't
on
know,
them.
Mal.
You
That's
don't
weird.
open them. Another hotspot area, you said accounts payable of companies. Explain that.
Yeah. So Paymerang is in the business of managing and supporting our clients with technology to automate their accounts payable, whether it's the approval of the invoices or the payment of those invoices to vendors. And what we've seen in that space is there's a lot of check fraud. Check fraud is increasing, believe it or not. And there's also a lot of wire and ACH fraud. So check fraud is about a $20 billion problem a year for businesses. And wire and ACH fraud is another $20 billion. Plus you add the cost of what we just talked about, cybersecurity, ransomware, that's about a $200 billion problem a year. So we're talking about a $250 billion problem, and it's affecting almost every company in the US, small, medium businesses. This is near and dear to our heart, that these small businesses are being impacted. You can protect against check fraud by implementing Positive Pay, which is a service that your bank offers to tell them which checks you've written, what the check numbers are, what the amounts are, and who the payees are. So this protects against even a check that's stolen in the mail that someone can wash and put their name on it. This protects against that because the payee will be different from the one that you had identified.
Oh, that's interesting. You know, I was going to ask you that because I actually have relatives that happened to recently. That is a growing concern. When you mail a check in the mail,
it's not safe.
No longer safe?
No. They're being
is there
intercepted.
anything you could do on this to make your check in the mail? I mean, that's how I still pay bills in many ways.
Yeah, and so, you know, what Paymerang does is we help businesses pay other businesses, and we help them pay them electronically, whether it's ACH or wire or card, virtual cards. With ACHs, you can create better security because it's not a paper check, it's not in the mail, and it doesn't have your account number.
Right.
But with ACH, there's also protection that you need. So if you're going to be wiring money, you want to make sure that you're wiring to the right account.
Right.
There's a new phenomenon that's been growing called vendor impersonation. And this is where someone will come to a company and say, I'm your vendor, but my bank account has changed. Could you pay the next invoice to this new bank account?
Yeah.
But it's an impersonator.
Makes
and
sense. I mean, if
there's a
you're
lot
trying
of
to be
things that we do to help them with that. What we'll say to them is, what companies should be doing is, one, when an email comes in from a vendor, verify that it is truly the vendor that you're interacting with.
Right. Well, it's the same thing. So like what you were saying about the bank, and so that they know who the payee is, and if it doesn't match, then there is a problem. You know, it's great to speak with you today, an important topic. Thank you very much.
Thank you so much for having me.
Nasser Chanda, thank you very much, of Paymerang. Glad you were with us. Still ahead, big banks. Well, we've been watching earnings season, and it kicked into high gear this morning. Next week, there's a slew reporting as well. Our panel weighs in.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in.
this week, of course, did the transaction getting out of consumer and selling Green Sky at a significant loss. But again, it's going to be the global risk as well as what they may do in trading as regulation increases capital reserves. Bank of America is more of the what's happening with the consumer and credit card. And again, across consumer and the areas of credit card, personal loans, we haven't really seen much in terms of delinquencies. These banks are really extremely well reserved. In the case even today of JP Morgan and Citigroup, they did increase the reserves, but not as much as the previous second quarter. So I think next week, the stage is really going to be set in terms of, well, what can Bank of America do? Because it's been probably one of the worst performing of the largest banks since March, when there were concerns about unrealized losses and not interest-bearing deposits moving to other places.
Right, and look, the big diversified banks generally are the ones that people count on. Final quick thought here, David, do you have a favorite?
Well, I think as I said to many people, I think you stay with the bigger banks. They have the ability to fight against competition that's out there, that's growing. They have the ability to work through any capital requirements. They're preparing for credit. I think they're going to benefit sooner from easing of the interest rate situation. So I think you just own the big banks and see what happens to the little guys. The smaller you get, you're going to get more sensitive to rates, more sensitive to credit, more sensitive to economic activity regionally. And that's a much tougher call. So I think I favor the bigger banks, and you just stay with those and wait for the recession to be over.
Right. David Ellison, Kenneth Leon, thank you both so very much. An important topic, these banks really setting the tone for earnings season for us on this Friday ahead of next week, a busy week for earnings, of course. Thanks for being with me. I'm Nicole Petalides, every day, 11 a.m. and 2 p.m. here on Schwab Network. Keep it right here. Caroline Woods, Market on Close, next.
Oh, I hope we break out for power hour. It's been dreadful. Liquidity being built for this range. Hour and 15 minutes. Not buying it. SPY. I want to see you break this high. Not a believer. There's Power Hour. He's gonna come in Fugazi. Make us wait. Pizza party. Thank God. Appreciate the donation, support, generosity. Thanks, Gods. Time to eat, that's right. The energy. Should have been done at 1. I was done. I was starting to get other stuff done, and then these candles turned my FOMO meter up. Gotta be careful, gotta keep your FOMO meter in check.
Let's get nuts!
Let's get nuts. Thanks for that, Guts. Maybe Spy can get nuts here today. Blast through VWAP to the top of that channel. Let's not do it in a day, let's do it like right now.
Some cautious commentary from Jamie Dimon, of course. Still up a little less than
Got
2%, but cut his
Caroline
gains in half.
for
What happened
Power
here?
Hour. That is
Well,
neat.
Caroline, I think the entire market is starting to come to grips.
This thing's gonna
with the
explode.
fact
Look at
that
all this
there may
liquidity.
be a
Once it goes,
significant amount of
big candle
geopolitical
straight to
risk
VWAP
over
probably.
the weekend and the coming days. You can see that in some key market metrics. You can see that in gold futures. You can see that in the VIX contract, and you can see that in bonds. Higher bonds, higher VIX, higher gold futures tells me that there's a risk-off sentiment coming into this market. And you're right. JP Morgan, that had a great first half of the day, is still up on the day, but it was over 153. It's almost $5 off its highs right now, Caroline. So I think as we get to the last hour of the trading week, I think there's some jittery
Straight landed.
Investors
On
out
the
there.
turn, I got the straight. Wow.
You know, thinking that this weekend there could be some serious
could go
geopolitical
down
headline
too.
risk, and so
They
I
probably
think
won't
that
VWAP,
is
though.
making the overall market as we speak jittery. But lower yields do bring in some dip buyers in the market. But right now, what you see in the risk-off assets is telling you that this market, Caroline, is jittery.
Yeah, we'll talk about the risk-off assets in just a second, but first, also want to talk about crude oil. Obviously, this uncertainty in the Middle East causing a pop in crude oil. It's good for energy stocks. If you take a look, S&P 500 energy sector, the best performer today. But how big of a market headwind could that ultimately be? Because this is a market that's been pretty resilient in the face of higher oil and despite geopolitical turmoil.
I sold some at that
but
high
not
again.
necessarily the case today.
Spy's gonna dance around.
Sure. When crude oil goes up like it did, and it's spiking today, make no mistake, that favors the energy market, clearly, but it hurts just about every other market that moves goods or services from point A to point B. It hurts the airlines, it hurts the cruise ships, it hurts trains, it hurts all forms of transportation, Caroline. This is, the story is, slowly but surely, over the last year, 18 months, 2 years, the U.S. has allowed Iran to really have almost record gas exports and crude oil exports. If that were to halt, if they were linked to what's going on in Israel and Gaza, if they're linked to that, and those sanctions are put back on, that could affect crude oil inventories in a significant way. And I think that's why you're seeing risk premium put back into crude oil. And as you know, when things are uncertain, stocks go down, commodities go up. And so I think you're seeing a spike in crude oil just for that reason, because it's the supply side.
I didn't realize he was calling. I thought he was raising.
Crude oil sold off the end of last week and early this week on demand destruction fears. This is back onto the supply side now, Caroline.
And then, as we said, seeing a pop in gold prices today. So that's flight to safety.
Yeah, despite a firm to higher dollar, this, that tells you that the reason that gold is rallying is some different relationship than just an inverse relationship to the U.S. dollar. So watching gold go up, and watch gold go up as much as it has right now, up over 3%, along with, normally that would be a one-off event, Caroline, but when you see the VIX go up, and when you see bonds rally like they are, that's a clear indication that there's a risk-off sentiment seeping into
pick up some more down here.
And the VIX, like I said,
keep trading this stupid little range. Look at that flash! Wow.
That says the tail risk, the little puts and out of the money puts are starting to trade for protection, Caroline, and that's another sign of risk off.
All right, well, we still have a little less than an hour to go before the bell, so let's see how this all shakes out for the market. Kevin Hanks, thanks so much. Now for a look at a few stocks on the move. I'm
could have gotten some calls on that dip, maybe.
Correspondent here on the network. So, Renita, you're taking a look at Qualcomm today. Shares off 2.5%.
Look, it's showing that left a gap there. That's crazy.
Jobs. Sometimes this gives a boost to stock prices because it ultimately means cutting costs, but not the case for Qualcomm. Fill us in.
Not at all today. And so Qualcomm said that it would lay off about 1,300 people, almost 1,300 people, coming from two of its California offices, one in San Diego, one in Santa Clara. That amounts to about 2.5% of the workforce, according to the last annual financial filing, and it's scheduled to begin sometime in the middle of December.
Crazy.
Now, this happens
like
as smartphone demand actually takes
ETF rebalancing or something.
Smartphone chip demand takes a dive, and that's Qualcomm's main revenue source. Now, it's not rebounded as quickly as it was expected to rebound, and the company's efforts to diversify the product range has not been strong enough to offset those declines just yet. And Qualcomm, by the way, is reporting earnings next month. Analysts are expecting to see a 19% drop in revenue for the current fiscal year. And meanwhile, though, Qualcomm did announce a quarterly cash dividend of 80 cents a share that would be payable December 14th, but doesn't seem like markets are happy about that part of the story today, Caroline.
No, shares off almost 2.5%, and actually negative for the year now, down about 1% year to date. You're also keeping an eye on Netflix. Shares off about 1.5%. This, of course, reports earnings next week. That'll be a big, a big name to watch next week. And Wolf Research is turning a bit cautious ahead of earnings. Tell us why.
King in there.
Wolf Research downgraded this stock today and removed the price target, which was about $500. The stock is trading well below $500 a share today, but it's the downgrade to peer perform from outperform. And this analyst is most concerned about Netflix's growth, saying that their forecasts are more concerning specifically. And the lead analyst says that Netflix will continue to gain the share of global premium video revenue, and it's also on track to create a massive long-term ad business, but he's concerned about the 2024 and 2025 growth forecasts. He says that Netflix's premium valuation multiple does not really provide a good margin of safety where it could be able to absorb the possibility of growth expectations slowing down.
Full house,
so in the medium term, he does say that the two biggest drivers of Netflix, of the multiple, also look risky, and when earnings do come out next week, we're looking for expectations of adjusted earnings of $3.47 a share on revenue of $3.53 billion.
All right. Well,
Friday
Wolf
indeed.
didn't provide a price target, but the price target, median price target for Netflix heading into earnings, $482. Currently trading at $355 right now. So Other analysts still very bullish on this name based on that price target. So we'll see if there are any adjustments, before or after Netflix actually reports. Renita Young, thanks for breaking down those big stories for us today.
Of course.
When are you going
Now
to
it's
go
time to bring
spy?
in our next guest. Mike Dixon is head of research at Horizon Investments. Mike, thanks so much for joining us.
Absolutely. Thanks for having me.
So, Mike, we've been focusing a lot on earnings today, as well as the move that we're seeing in gold. But ultimately, when we think about the week, it was a big week in terms of inflation as well, getting PPI and CPI really showing that inflation is moderating, but sticky, if you will. Just in terms of the outcome of that data, does it change anything in terms of what the Fed does next, and what does the Fed do next?
Spy is not cooperating.
I really don't
Complete
think the
party
reports
pooper.
this week
It
changed
will.
much.
It will. Just
you're
might be in the
certainly
last
right. I mean,
5
they
minutes.
were, showing some signs
Not
of
letting me
stickiness.
cut out early.
You see it today with oil up a lot.
I was waiting.
That
I was sticking around for
probably
the
is going to keep,
pizza party
inflation
dono.
a little bit sticky.
I had to.
As far as
We're
the
gonna be
Fed
hungry
goes,
otherwise.
I mean, one of the things that
Kids
we
would be
have
like, Dad,
seen,
why don't we have pizza
over the
tonight? Why are
last
we
several months is
hungry?
just a very large increase,
Got the
of
stream
course,
off too
in
early,
longer-term
kids.
yields. And that has not been driven by expectations for Fed
Sorry.
policy, nor has it been driven by expectations for higher inflation. And so that is a real growth, increase in the term premium that is much more in line with longer term levels. We view that as certainly a very good thing. And, another thing supporting those high yields has been just the extremely strong economic growth numbers we've seen. I think the Atlanta Fed GDP now forecast has Q3, calculated to come in around 5.1% right now. That is a very strong number. We think that's going to be supportive of earnings.
There it
But
is.
most
Well,
importantly,
liquidity just
supporting those
one
higher
candle
yields,
VWAP.
that's doing a little bit of the Fed's work for them. So I think it gives them time to be patient and continue to watch the data.
Okay, so in terms of earnings, you were talking
Straight
about being
pizza 3 of a
supportive of
kind,
earnings.
right?
Obviously kicked off earnings season really this week.
Yeah,
today
I'll just
with
call.
the big banks.
Yeah, good.
So far, looks pretty good. What's your expectations for
Okay,
earnings
it's come
season
down on Friday,
in
indeed.
terms of it being a positive or negative catalyst for this market?
Yeah, I mean, look, a trend we've seen all year, what we've been talking to a lot of our clients about is just the constant string of surprises that you've seen both on the economic data front throughout the year as well as the earnings front. The first three earnings quarters this year, we've had very strong surprises in the 7 to 8% range on the bottom line. And I think a lot of that is due to the fact that, in general, a recession has been the base case coming into the year. And, analysts and economists alike have been a little reluctant to aggressively increase their forecast as a result. So coming into this earnings season, I still think there's a lot of those, recession fears baked into the estimates. And I think that makes for a relatively low bar coming into this earnings season. I think it sets up really nicely for a potential catalyst heading into year end because, I think there's a really good setup for the market to go higher from here.
You really gonna still play this spy?
And,
Come on,
inflation this
pizza
week had the
party
opportunity
Friday.
to do that. It certainly did not deliver. It did not deliver the spark we were looking for, but I think earnings really have the potential to do that, especially with the strong economic growth. And, like you said, this number, all the companies on my screen had very strong surprises. So it's a great start to the season.
Tell us why this market is set up for gains heading into year end. Because I was taking a look at your notes. You say the setup we have coming into year end looks like a coiled spring. Where do you draw your bullishness from other than the fact that earnings expectations are low and you're looking for some beats?
Well, that's certainly one area, right? The fact that we've continued to see these recession fears get baked into estimates. And while we did see a slight increase in earnings expectations for this quarter following the very strong earnings season, in Q2, it hasn't been a tremendous amount. So I do think the bar is low. Another thing I'll point to is just looking at the performance of the average stock versus the broad market. That is basically at a 30-year low where we sit year to date with, the equal weight S&P underperforming the market cap S&P by about 12% where we sit year to date. Now that in and of itself does not mean the market's going to go higher, but what it does mean is that there's a large number of stocks out there that have really yet to participate in some of the recovery like we've seen in, the Magnificent Seven and the top heavy portion of the market. Third, I'll say when it comes to interest rates, look, we have seen them move higher, right? Term premium especially. So those longer term yields have come up without bringing up Fed expectations or inflation expectations. And that's good because
what
the
the
market
heck?
will,
You got it on the river too?
on the rate
Just
side
bluffing the
of things,
flush?
to support stocks with any sort of weakness.
Yeah, he landed on the river.
And, finally, we've seen $1 trillion in money market funds.
He maybe had it before, but then he got a higher share on the
A lot of
river.
money on the sidelines. So, in aggregate, I think that setup is very strong. We just need a good spark on the inflation or earnings front, I think, to really take us to new highs.
Okay, so tell us how you're positioning your portfolios right now. What are you comfortable buying in expectation of a potential run up into year end, given the strength in some of the sectors that we've already seen?
Yeah, most importantly on the equity side of things, we've been, overweight the U.S. markets. There's certainly, been a lot of turmoil overseas in the international space, and China has been difficult as well. So we favored the U.S. throughout the year. And also I'll point to just, kind of quality growth stocks have been, something that we have really liked. And that's paid off quite well this year. When you look at the international side of things, I think Japan is probably our favorite there within the international space, but we certainly have been biased to the U.S. on the equity side. And look, when you look at fixed income, broad passive bonds, they barely have a yield, equal to the risk-free rate right now. And so the risk premium there is very low. You've also seen broad passive bonds be quite volatile and not really act as a diversifier. So we have not been a big fan of really the duration trade or the safe kind of investment grade space. But high yield bonds, we are going to be getting 7, 8, 9% yields. Since our view really is no recession, we really like that part of the market on the fixed income side of things to clip those higher coupons, in spite of some short-term volatility fluctuations.
Closing low today.
All right, we appreciate
Maybe.
those picks and your insights.
This might be liquidity for it to close down there. I don't know.
Absolutely. Thanks for having me.
I want safety for a Friday.
Have a good one. Coming up,
Safety
higher rates are
VWAP.
concerned for some areas of real estate, but we'll find out why AI might be booing some REITs right now. Stay right here on Schwab Network.
Booing.
Market on Close. We'll be right back.
Yeah, I don't have a whole lot of TA showing it's going to go up to VWAP. It's just more likes to do that. we have had tapering today though, for sure. So on the downtrend, but since it is end of day, it might not play out. These tables guys suck. Maybe I suck. Can't pay attention. I'm out of those. I don't want to mess with it anymore. I suck. Gave back a day's worth of gains. It's just gambling in today. It's dumb. Okay, I'm gonna cut it early. Thanks, guys, for your support. Hope you guys had a good week. Have a good weekend. Take it easy. Guts, thanks for the pizza party. We will enjoy it in your honor. Well, SPY's down 0.5%. And yesterday we did have that big engulfing red candle. So we'll see. We'll see if we continue down. Today, did we bounce on that level? Kind of. Kind of bounced on that low from back here. Just below it. Very interesting. AMC sold off a lot, down 14%. Could really honestly should be some consolidating. This is the support. Held above that support at least at 930 something. That's good. I haven't even looked at GME. GME down 1.3. Yep. What did we have? We came back up a little bit today. GNS down 12. RAD is down 14. Yeah. I guess I just traded SPY today. That's it. I'm not gonna review it. I'm gonna get out of here. I did well though. I was patient, other than the last couple hours through this gauntlet of market maker thievery. Other than that, it was pretty good. I was actually up this morning, just doing small trades, more scalps on the way down because there wasn't a good. This would have given an entry, but I wasn't prepared. So really didn't make a whole lot through all this, like a little bit, and then just waited for. I actually think I caught this little downside right there. No, where was it? This one. Caught this downside right here, and then started getting calls. Yeah, started getting entry calls right here, and then added a bunch on the break of this channel. That was my biggest trade today. It was just a large position. Closed them out up here, thankfully, and here, and then didn't get into puts here because managing those calls and yeah, whatever. Did get the puts though. Get them here. Yeah, I did. I got the puts here. I got puts for this move, and then I think I maybe held them down to there. Yeah, I did. I think I closed some down there. So today was a green day. I'm very thankful. After yesterday, I was like, all right, I just gotta be really chill today. Like, just watch the market today and not even mess with it. But saw some opportunities and took it. I was up pretty good, and then gave back half my profits, unfortunately, with this. But still, very thankful to be green. Had a good week. Hoping that this is the beginning of a good trend, a good streak. So, thank you guys for your support. I really appreciate it. Thanks, Guts. Thanks, Kitty. Thanks, Jay. Bubba. See you guys on Discord. Thanks, Maui Sam, if you're still around. Ooh, we will see you on Discord. See you on Twitter. Monday, market's open. Yeah. All right. Thanks, guys.